So look at question number 44. Following information has been provided from the books of Lakshmi Private Limited for the financial year ending 31st March 2023. Net working capital of the company is 4,80,000. Bank overdraft 80,000. This bank overdraft is nothing but current liability. Fixed asset to proprietary ratio is 75%, which is nothing but fixed asset divided by proprietors fund. Proprietors fund includes equity shareholders fund as well as preference shareholders fund. And reserves and surplus 3,20,000. Current ratio is 2.5:1 and liquid ratio is 1.5:1. The requirement of the question is to prepare a summarized balance sheet as on 31st March 2023, assuming there is no long-term debt for the company. So whenever net working capital is given and current ratio is given in the question, so the starting point of the question should be to calculate current asset and current liability. So working note number 1. Question number 44. Working note 1. Current asset and current liability. So net working capital is nothing but current asset minus current liability is equal to 4,80,000. So we can write current asset is equal to 4,80,000 plus current liability. So this can be written as equation 1. Next, current ratio is nothing but current asset divided by current liability. In this question, current ratio is given as 2.5:1. So current ratio is 2.5/1 is equal to current asset by current liability. So we can write the equation current asset is equal to 2.5 times current liability. So this is equation 2. Now equation 1 is also current asset, equation 2 is also current asset. So equating equation 1 is equal to equation 2. So 4,80,000 plus current liability is equal to 2.5 current liability. Now what is the value of current liability? Current liability is equal to 3,20,000. Now from equation 1 we know that from equation 2 we know that current asset is nothing but 2.5 times of current liability. So what is the amount of current asset? Current asset is equal to 2.5 into 3,20,000. We get 8 lakh rupees. So far clear? Any doubt? Now listen, in the question it is mentioned that fixed asset to proprietary ratio is 75%. So let me show it over here. Liability side, then asset side. On the liability side, in this question what do we have? We have equity share capital, preference share, equity share capital, reserves and surplus, and preference share capital. Equity share capital, reserves and surplus, then preference share capital, and then we have current liabilities. In this question it is specifically mentioned that assume there is no long-term debt. So there is no long-term debt. We have equity share capital, reserves and surplus, and preference share capital. All these three things can be, when we put all these three things together, equity share capital plus reserves and surplus plus preference share capital, it is known as what? Proprietors fund. On the asset side of the balance sheet we have fixed asset and current asset. In the question it is mentioned that proprietors fund is 75%, fixed asset is 75% of the proprietors fund. Clear? Which means out of the total proprietors fund, we use 75% for financing fixed asset. Is this clear? Any doubt? Now, what we can do is, I can remove this current asset, I can remove the current liability from the liability side, and I will write it as current asset minus current liability. So from the liability side also I am decreasing the current liability amount. From the asset side also I am decreasing the current liability amount. So the net effect on the balance sheet is 0, right? So out of proprietor's fund, if 75% is used for financing fixed asset, remaining 25% is used for what is current asset minus current liability? Working capital. So we can say that 25% of proprietor's fund is equal to net working capital. Is this part clear? Any doubt? Did you all understand? Clear? Now write on working note number 2. Proprietor's fund. Proprietary fund. So 0.25% of proprietary fund is used for financing net working capital. Is this equation clear or you want me to explain it again? Your study material, they did not follow this method. Actually, they have solved it using a very lengthy method. But is this clear? Did you all understand till this part? So proprietary fund, 25% of proprietary fund is, what is net working capital? It is 4,80,000. So proprietary fund is equal to how much? 4,80,000 into 4. So 19,20,000. So far clear? Any doubt? Right? Now we know that out of proprietary funds, how many percentage is fixed asset? 75%. So in the second working note itself, we can calculate proprietary fund as well as the fixed asset. So what is the amount of fixed asset we get? Fixed asset is equal to 0.75% of 75% of proprietary fund. So what is the amount of fixed asset? 14,40,000. So till this part clear? Any doubt in this? Understood, everyone? So now listen, on the balance sheet side, we know what are all the items that we need. So on the asset side, we will have fixed asset and current asset. We have already calculated fixed asset and we have already calculated current asset. On the liability side, we have already calculated current liability. So now we have to calculate equity share capital, reserves and surplus on preference share capital. Now reserves and surplus is something which is directly given in the question. Just 3,20,000. Now how can we calculate equity share capital and preference share capital in this question? What can we do? Total proprietors fund is how much? 19,20,000. Out of that 19,20,000, reserves and surplus is 3,20,000. So the remaining portion is nothing but share capital, which includes equity share capital and preference share capital. Here they have not mentioned specifically to calculate equity or preference. So you can write it as just share capital, right? So now we have all the relevant information for calculating. We have all the relevant information for preparing the balance sheet, but we calculated current asset. Now from that current asset we can show the bifurcation of inventory using quick ratio. So prepare working note 3, quick ratio. Working note 3, inventory, calculating inventory using quick ratio. Quick ratio is how much? 1.5 is equal to current asset minus inventory by current liability. So what is the current asset we calculated? 8 lakh. Minus inventory we need to calculate divided by current liability is 3 lakh 20,000. So what is the amount of inventory we get? 4 lakh. So 3 lakh 20,000 inventory. $320 into 1.5. 320 into 1.5 is 160. So 480. So inventory is 3 lakh 20,000. No. So the amount of inventory is 3 lakh 20,000. So now prepare the balance sheet. Asset. So on the asset side, first we have fixed asset. What is the amount? 14 lakh 40,000. Then we calculated inventory. Inventory is 3 lakh 20,000. So the total current asset is 8 lakh rupees, out of which 3 lakh 20,000 is inventory. So the remaining 4 lakh 80,000 is nothing but other current assets. So what is the total of the asset side? $26 lakh 40,000. Sorry, 22 lakh 40,000. Next on the liability side, we have share capital. So what is the total share capital? Total proprietors fund is 19 lakh 20,000, out of which reserves and surplus is 3 lakh 20. So remaining 16 lakh has to be the share capital. And then we calculated total current liability, how much? 3 lakh 20,000. But in the question it is specifically mentioned bank overdraft is 80,000. Bank overdraft is 80,000. So the remaining, how much? 2 lakh 40,000 is nothing but other current liability. So other current liability is 2 lakh 40,000. Check whether the total is matching or not. 22 lakh 40 and 22 lakh 40 is 22 lakh 40,000. Everyone done till this part? Any doubt in this question? Clear? So look at next question, question number 45. Manan Private Limited gives you the following information relating to the year 31st March 2023. Current ratio is 2.5:1 and debt to equity ratio is 1:1.5. Return on total asset is 15% and return on total asset is given as after tax. So which formula we can use? EBIT into 1 minus T by total asset. Total asset turnover ratio is 2 times, which is sales by total asset. Gross profit ratio is 20%. Stock turnover ratio is 7 times. Net working capital 1350. And listen, in this question, current ratio is given, net working capital is given. So the starting point should be first working notice to calculate current asset and current liabilities. Then fixed asset is 30 lakhs. In this question, they have given equity shares as 18 lakh rupees, right? Just assume this information is not given in the question. So you solve this question as if there is no equity shares given in the question. We have to calculate the amount of equity because in your study material, this 18 lakh rupees of equity is given in the question and they calculated a different equity value in the solution. Still, the equity value they got, it was 22 lakh 50,000. It is fine, but the problem, okay, we can assume that 18 lakh rupees of share capital and 4 lakh 50,000 rupees of reserves and surplus. But they have calculated this 22 lakh 50,000 using this ratio that was very confusing. So assume this 18 lakh rupees was not given in the question and solve it. Preference share capital is 6 lakh rupees. Opening stock is 11 lakh 40,000. Since opening stock is specifically mentioned in the question, while calculating stock turnover ratio on the denominator, we have to take average inventory. Now requirement of the question is to calculate quick ratio, fixed asset turnover, proprietary ratio and earnings per share. So what is the first requirement of the question? To calculate quick ratio. What is the formula for calculating quick ratio? Current asset minus inventory divided by current liabilities. Nothing is mentioned with reference to prepaid expense in this question. So how can we, first for calculating quick ratio we need current asset. How can we calculate current asset? Using net working capital and current ratio we can calculate current asset. Denominator of the formula is current liability. So we can calculate current liability also using current ratio and net working capital. We also need inventory for calculating quick ratio. Inventory can be calculated using stock turnover. What is the formula for calculating stock turnover? COGS by average inventory. So for calculating inventory we need COGS also. Clear? Any doubt? Did you all understand? So write down first requirement, first working note 1. Current asset and current liability. So quickly calculate the current asset and current liability and tell me the numbers, how much. We have net working capital, which is current asset minus current liability. We have current ratio, which is current asset divided by current liability. So calculate the amount of current asset and current liability until how much it is. Current asset is how much? Current asset is equal to 22 lakh 50,000. Current liability, everyone done with this? Everyone done with the first working note? Now listen. In this question, total asset turnover ratio is given, which is 2 times. Is total asset directly given? No, total asset is not directly given, but we have fixed asset of 30 lakhs, and just now we calculated current asset of 22 lakh 50,000, right? So working note 2, we can calculate what? We can calculate sales, right? Because okay, we write it as total asset as well as sales. We will calculate both total asset, sales, and COGS also we can calculate because gross profit is given. So total asset, sales, and COGS. So what is the total asset formula? It is fixed asset plus current asset. So total asset is equal to 30 lakh plus 22.5 lakh. How much do we get? 52 lakh 50,000 or 52.5 lakhs. So here in this question we have the total asset turnover ratio, for which the formula is sales divided by total asset. What is the total asset turnover ratio? It is 2 times. 2 is equal to sales by total asset of 52.5 lakhs. So what is the amount of sales we get? 52.5 into 2, so 104. So how much? 1 crore. So till this point, is it clear? Any doubt? So now we can calculate COGS from this. In the question it is mentioned that gross profit is 20%. So remaining 80% has to be the COGS. So calculate COGS. 1 crore 5 lakh into 80%. How much do we get? 84 lakh is the cost of goods sold. Clear? Any doubt? So now we have calculated COGS. So now we can calculate the closing stock using stock turnover ratio. Write down working note number 3. Closing stock. So what is the formula for stock turnover? Stock turnover is equal to COGS divided by average inventory. Stock turnover is 7 times. COGS is how much? 84 lakh divided by average inventory. So what is the amount of average inventory we get? 12 lakhs, right? Average inventory is equal to 12 lakh rupees. So this average inventory is nothing but opening stock of inventory plus closing stock of inventory divided by 2 is equal to 12 lakh rupees. Opening stock is directly given 11 lakh 40,000. So from this we can calculate the closing stock of inventory. Plus closing stock by 2 is equal to 12 lakh. So what is the closing stock of inventory? 12 lakh 60,000. So far any doubt in this? Clear? Did you all understand till this part? Now we have calculated total asset. So total asset is 52 lakh 50,000. We know that total asset should be equal to total of the liability side. So on the liability side we will have debt plus equity plus preference share capital plus current liability. So out of these figures we don't know what is debt, we don't know what is equity, but we have the relationship between debt and equity. Preference share capital is given in the question 6 lakh and current liability is something which we calculated. How much? 9 lakh, right? So now working note number 4. Calculation of debt and equity. So we know that total asset is equal to total liability. So total asset is equal to debt plus equity plus preference share capital plus current liability. What is total asset? 52 lakh 50,000, which is equal to, listen, the relationship between debt and equity is, debt to equity ratio is 1 by 1.5. So we can write equity is equal to 1.5 times debt, right? So here what I am doing, I will take debt as debt plus we will write equity as 1.5 times debt. Is this clear? Any doubt in this? Did you all understand? So let me write it over here. Debt by equity is 1 by 1.5. So equity is equal to 1.5 times debt. Plus preference share capital is how much? 6 lakh. Plus current liability is 9 lakh. So with this we can calculate the value of debt. So what is the value of debt we get? $15 lakhs. So value of debt is 15 lakh rupees. Now we know that equity is equal to 1.5 times of debt. So what is the amount of equity? 22 lakh 50,000. Clear? Any doubt? See, I told you to ignore this amount of equity shares, right? Because if you are taking this equity shares here, then you don't need to write it as 1.5 times debt. You can directly write it as 18 lakh itself. In that case, you will get a different value for debt. So that is the problem with this question. So assume there is no equity share given in the question and solve it. Right? Any doubt so far? Calculation of debt and equity clear? So now for calculating quick ratio, we have calculated almost all the relevant information. For fixed asset turnover ratio also we have the relevant information. Sales by fixed asset. For proprietary ratio, what is the formula? Proprietor's fund divided by total asset. We have the relevant information. For earnings per share, we need to calculate net income and the number of outstanding shares. So here we have calculated equity as 22 lakh 50,000, right? Assume face value is 10 and take this number of outstanding shares as 2 lakh 25,000. Clear? Net income can be calculated using return on equity formulas. Return on total asset after tax is given. So return on equity is also given, no? It's not given. Okay. So with this we can calculate the net income. So for calculating EPS we need net income. So write down working note number 5. Tax rate is given. Tax rate is not given. Interest percentage not given. Okay, so in this case what we can do is we have to make an assumption that return on total asset is calculated using the formula net income by total asset. Because if you want to take EBIT into 1 minus T, tax rate is not given. If you want to use the other formula PAT plus interest rate is also not given in the question. So we will assume return on total asset is calculated as net income by total asset. So working note number 5, net income. So net income divided by total asset is equal to how many percentage? 15%. So net income is nothing but 15% of total asset. 15% of what is the total asset? 52 lakh 50,000. So what is the amount of net income we get? 7 lakh 87,500. Clear? Any doubt in this calculation? So now we have all the relevant information for calculating the 4 ratios. So let's solve it. Requirement A, quick ratio. What is the formula for quick ratio? Current asset minus inventory by current liability. What is the current asset we calculated? 22 lakh 50,000. Inventory, closing stock 12 lakh 60,000 divided by current liability 9 lakh. So how much do we get quick ratio? 1.1:1. So 1.1:1 is the quick ratio. So next we have fixed asset turnover ratio. What is the formula for fixed asset turnover ratio? Sales by fixed asset. So sales is 1 crore 5 lakh divided by fixed asset how much? 30 lakh given in the question. So what is the fixed asset turnover ratio? .5 times. So next we have to calculate proprietary ratio. What is the formula? Proprietary ratio is equal to proprietor funds divided by total asset. So in this case proprietor funds includes equity share capital as well as preference share capital. What is the amount of equity we calculated? 22 lakh 50,000 plus preference share capital of 6 lakh divided by total asset of 52 lakh 50,000. How much? 0.54 or 54%. So requirement D is to calculate earnings per share. Formula for EPS is net income divided by number of outstanding shares. So net income is 7,87,500 divided by outstanding shares is total value of equity is 22,50,000. Assume one share has a face value of 10 rupees. So we get 2,25,000. What is the EPS? 3.5 per share. Clear? Any doubt in this? Everyone understood till this part? So look at question number 46. So this is actually you can take it as a homework, but I'll just explain what you have to do in this question. Very simple. Share capital 40 lakh on 31st March 2022 and 40 lakh on 31st March 2023. Long term loan is also 30 lakh rupees and 30 lakh rupees. Reserves and surplus at the beginning of the year was 20 lakh and at the end of the year was 5 lakh. So there is a difference of 5 lakh rupees, right? Beginning of the year it was 20 and end of the year it was 25. So there is a difference of 5 lakh rupees. What is this 5 lakh rupees? 5 lakh rupees is nothing but net profit, right? So now we have net profit as 5 lakh rupees. We have net profit ratio, so with this we can calculate sales. After calculating sales we have gross profit, so we can calculate gross profit and COGS. So after calculating COGS, we have inventory turnover. With that we can calculate the amount of inventory. You're all getting the point. Inventory turnover ratio is 4 times. So COGS by inventory is 4 times. So we can calculate inventory from this. And we have already calculated sales. Debtors days is given 90 days. So with that we can calculate the amount of receivables. And the company holds cash equivalent to 1.5 months of cost of goods sold. So what is this? This is similar to what we did over here. In this question, we calculated stock of raw material as 3 months usage. So how did we calculated it? We calculated the total raw material consumed and multiplied it with 3 by 12. So similarly here we have already calculated COGS. To that COGS, if you multiply it with 1.5 by 12, we will get the cash, and this amount needs to be shown in the balance sheet of the company. Clear? Any doubt? And it is specifically mentioned in the question to have 360 days in a year, to assume 360 days in a year, and long-term loan has been used to finance 40% of the fixed asset, which means fixed asset is nothing but 40% of the long-term loans. So any doubt in this? Clear? So you can take it as a homework, right? So look at question number 47. Following information relates to Timur Limited. Debtor, and one more thing, this is a study material question only, so you can check the answer. Following information relates to Timur Limited. Debtor's velocity is 3 months, or we can write it as 90 days. Creditor's velocity is 2 months or nothing but 60 days. What is the formula for creditor's velocity? Credit purchases divided by payables into that's all. Credit purchases divided by payables. But formula for creditor velocity is payables divided by credit purchases into 360. Stock turnover is 1.5 times. Gross profit ratio is 25%. Bills receivable 25,000. Bills payable 10,000. So bills receivable should be used while calculating. In the debtor's velocity, we will include bills receivable. In the creditor's velocity formula, we will use bills payable. Gross profit is 4 lakh rupees, and fixed asset turnover ratio is 4 times. Closing stock of the period is 10,000 rupees above the opening stock. So we have to use average inventory in the denominator while using stock turnover ratio formula. First requirement of the question is to calculate sales and COGS. So how can we calculate sales and COGS here? Gross profit margin is given and gross profit is also given. So we can calculate sales from that. From sales, how many percentage is COGS? 75%. Then we have to calculate sundry debtors using debtors velocity. We have to calculate sundry creditors using debtors velocity. But calculating sundry creditors is slightly different here. We will discuss it. Then we can calculate closing stock using inventory turnovers. Then we can calculate fixed asset using fixed asset turnover ratio. Clear? Any doubt? So look at question number 47. Question number 47. Working note, we can directly write it. Requirement 1. Sales and COGS. So gross profit is 4 lakh rupees and gross profit margin is 25%. So this 25% is nothing but 25% of sales, right? So write down 25% of sales is equal to gross profit. So 25 by 100 into sales, we don't know. Gross profit is how much? 4 lakh rupees. So what is the amount of sales? 16 lakh. So amount of sales is 16 lakh rupees. Clear? Now we can calculate COGS COGS is equal to sales minus gross profit or sales into 75% in this question. So what is the COGS? In this case it is 12 lakh. Clear? Any doubt so far? Now listen, we have sales. We can calculate the fifth requirement after solving the sales and COGS, because we have fixed asset turnover ratio 4 times, right? So we will calculate that next. Calculation of fixed asset. Fixed asset turnover ratio is equal to sales by fixed asset. So fixed asset turnover is 4 times. 4 is equal to, what is the amount of sales? It is 16 lakh divided by fixed asset. So what is the amount of fixed asset we get? 4 lakh rupees. Clear? Any doubt so far? Next, when you look at the second requirement is to calculate sundry debtors. Sundry debtors can be calculated using debtors velocity. So third requirement, sundry debtors. So what is the formula for debtor velocity? Sorry, receivables by credit sales. Receivables by credit sales into what? 360. So debtors velocity is 90 days given in the question. Receivables is how much? Okay, wait. If you look at the theory, we already discussed the trade receivable includes the sundry debt. Okay, fine. The trade receivable includes both sundry debtors and bills receivable, right? In this question, bills receivable is directly given, which is how much bills receivable? Bills receivable is 25,000 plus sundry debtors. So receivables we can write it as 25,000 of bills receivable plus sundry debtors divided by, what are the credit sales? 16 lakh rupees into 360. See, nothing is mentioned in this question with reference to credit sales, so we can assume all the sales are on credit. So what is the amount of sundry debtors? 4 times 3,75,000, is it? This 4 times 4 lakh minus 25,000, 3,75,000 sundry debtors. Clear? Now listen. Next, what is the requirement? Sundry creditors. So what is the formula we can use for calculating sundry creditors? We can use creditors velocity and we can calculate sundry creditors. But the problem is, for calculating credit velocity, in the formula we need credit purchases. Do we have credit purchases here? No. So how can we calculate it? We have COGS, right? We know the formula. COGS is equal to opening stock plus purchases minus closing stock. For calculating purchases, here we need opening stock and closing stock. How can we do that? We can calculate it using stock turnover ratio. Is it clear? So now we will do the fourth requirement first and then we will do the third requirement, closing stock, and then we will do the sundry creditors calculation. Closing stock. So closing stock can be calculated using the formula inventory turnover, which is COGS divided by average inventory. In this question, it is specifically mentioned that closing stock is 10,000 rupees more than the opening stock. So inventory turnover ratio, inventory turnover 7 times, right? Inventory turnover how much? Okay, 1.5 times. Okay, 1.5 times is equal to COGS 12 lakhs divided by, listen, for average inventory, listen. So what is average inventory? Opening stock plus closing stock by 2. Closing stock of the period is 10,000 rupees above the opening stock. So we will take opening stock as X. Plus we have to add closing stock to this. We know that closing stock is 10,000 rupees more than opening stock. So we can write closing stock as X plus 10,000 divided by 2. Clear? Understood everyone? So now calculate the value of x. Value of x is nothing but opening stock. Add 10,000 to that, we will get closing stock. So x is opening stock. So x plus 10,000, that will give us the value of closing stock. So what is opening stock and closing stock? 7,05,000 and 6,95,000 and 7,05,000. You get? Oh, which one is 7,95,000? Okay, opening stock 7,95,000, 8,05,000. Did everyone get this answer? Everyone done? So the answer for the fourth requirement is 8,05,000. So now let's calculate the answer for the third requirement, sundry creditors. So which formula we can use? We can use the creditors velocity formula. Creditors velocity is equal to credit purchases by payables into 360. But for calculating this, we need credit purchases first. So we know the formula COGS is equal to opening stock plus purchases minus closing stock. COGS is 12 lakh. Opening stock is how much? 7,95,000 plus purchases minus closing stock 8,05,000. So what is the amount of purchases we get? Minus 10,000, so plus 12,10,000. Did everyone understand till this part? The formula is not credit purchases by payables, no, it is payables by credit purchases, no. Here, for payable turnover only, it is credit purchases by payables. So payables by credit purchases. So any doubt in the calculation of purchases? Is it clear, everyone? Now calculate, apply the numbers in the formula. Credit velocity is 60 days. 60 days is equal to payables include, listen, here we have bills payable also. So payables includes bills payable of 10,000 plus creditors divided by credit purchases is 12,10,000 into 360. So how much do we get creditors amount? Now it will be in decimals, yeah, 1,91,000. Done? Any doubt in this? Clear? Everyone done? So now look at question number 48. So 48, from 48 question, all the questions are PYQs. So this 48th question was tested in May 2024. So look at question number 48. 12.5% debt is 45 lakh. Debt to equity ratio is 1.5:1. So we can calculate the amount of equity from this. Return on shareholders fund is 54%. So by making use of these two figures we can calculate equity. Then by making use of equity and return on shareholders fund we can calculate net income. Return on shareholders fund is return on equity. So net income by equity. Operating ratio is 85%. What is this operating ratio? We will discuss while solving question. Ratio of expenses to COGS is, ratio of operating expenses to COGS is 2:6. For every 6 rupee of COGS, there is a 2 rupee of operating expenses. Tax rate is 25%. Fixed asset is 39 lakh. Current ratio is 1.8:1. Requirement of the question is to calculate interest coverage ratio. What is the formula? EBIT by interest. Next we have to calculate gross profit ratio, gross profit by sales. Then we have to calculate current asset. By making use of current ratio we can calculate current asset. Right? So first we need to calculate interest coverage ratio. We need EBIT and interest. One component of the formula, that is denominator, interest, can be calculated directly. Total debt is 45 lakh on which we are paying 12.5% interest. So 12.5% of 45 lakh we get 5 lakh 60 to 500. That is the amount of interest. But we need to calculate EBIT also. So how can we calculate EBIT? First we can calculate net income. Then we can do the reverse calculation for calculating EBIT. So write down question number 48. Working note number 1. Or else we can write it as direct requirement itself. Requirement 1. Interest coverage ratio. Interest coverage ratio. So interest coverage ratio is equal to EBIT by interest. So we know the format that EBIT we have to calculate. From EBIT if we subtract interest we will get EBT. From EBT if we subtract tax, what is the tax rate? 25%. So tax at 25%. Then we will get earnings after tax. Right? In this question, what will be the earnings after tax? Go for that. First we should have calculated equity. Okay, fine. Debt to equity ratio is 1.5:1. So below this write down debt to equity ratio is 1.5:1. So we know that equity is equal to debt divided by 1.5. Is it clear? So equity is equal to, what is the amount of debt we have? Debt is 45 lakh. So 45 lakh divided by 1.5 we get equity. So what is the amount of equity? Equity is 30 lakh rupees. Is this clear? Now return on shareholders fund or return on equity is given as 54%. So EAT is nothing but 30 lakh into 54%. How much do we get? 16 lakh something. 16 lakh 20,000. So from EBT we are paying 25% tax. So 16 lakh 20,000 is how many percentage of EBT? 75%. So calculate the amount of EBT. 21 lakh 60,000. So the amount of tax is 5 lakh 40,000. 5 lakh 40,000 is the tax. Now what is the amount of interest? 5 lakh 62,500. So what will be the EBIT now? 2160 plus 562 500. EBIT is 27 lakh 52,500. 27, 22, 500. So till this part, is it clear? Everyone understood? So now just apply the numbers in the formula. Interest coverage ratio is equal to 27,22,500 divided by amount of interest is 562,500. So what is the interest coverage ratio? 4.8, 4.84 times. Clear? Any doubt in this? Now look at the second requirement. We have to calculate gross profit ratio. So for calculating gross profit, we need what? Sales. We need gross profit and sales, right? Listen, one information relating to COGS is given in the question, that is ratio of operating expenses to COGS is 2:6. Then operating ratio is given as 85%. So what is operating ratio? This operating ratio is nothing but operating expenses plus COGS by sales is equal to 85%. Clear? Any doubt? So out of sales, 85% includes COGS and operating expenses. So the remaining 15% has to be the what? Did you understand the question? Wait. Requirement 2, we have to calculate gross profit ratio. For calculating gross profit, we need sales and gross profit, right? So gross profit can be calculated as sales minus COGS. One information relating to COGS is given in the question, and that is related to operating expenses. In this question, they have given operating ratio, right? That operating ratio is nothing but, write down, operating ratio is equal to operating expenses plus COGS divided by sales. So now listen, then you can write it down. Listen first. From sales, if we subtract COGS, what do we get? Gross profit. From gross profit, if you subtract operating expenses, what do we get? EBIT. Clear? Now out of sales, COGS plus operating profit is what? 85%. Then remaining 15% has to be what? Your EBIT. Because from sales, you are subtracting COGS and operating expenses, you will get EBIT. Sales is what? 100%. If these two things put together, we are getting 85%. Then remaining 15% is what? EBIT. Is this clear? Did you all understand? Any doubt in this? Want me to explain it again? Clear? So now we can say that EBIT is equal to, or else wait, write it in this way. 85% of sales is equal to operating expenses plus COGS. So remaining 15% of the sales is equal to EBIT. Now we have already calculated EBIT, the first requirement, 27,22,500. So 15% of sales is equal to EBIT of 27,22,500. So what is the amount of sales we are getting? One crore 81 lakh 50,000. Till this part, is it clear? Any doubt in this? So So sales minus COGS minus operating expenses is nothing but EBIT. COGS plus operating expenses is 85% of sales. Then obviously remaining 15% has to be EBIT. Done, everyone, till this part? Is it clear? Any doubt in this? Now listen, in the question it is mentioned that ratio of operating expenses to COGS is 2:6, right? So write down. Operating expenses to COGS is equal to 2/6. So we can cancel it out 1 and 3. So we can write COGS is equal to 3 times of operating expenses. Did you all understand this one? Now we know the amount of sales. And here, if you apply the numbers in this equation, we can calculate COGS. So just write it as equation 1, applying the numbers in equation 1. So we know that 85% of sales is how much? 1 crore 81 lakh 50,000 is equal to operating expenses plus COGS. Now we can write operating expenses plus we can write COGS as 3 times of operating expenses. Is it clear? Any doubt? Now calculate the amount of operating expenses. How much do we get? 38 lakh 56,875. Did everyone get this number? Done? Everyone done till this part, or till operating expenses? Everyone done? Now we know that COGS is equal to 3 times of operating expenses. So write it as equation 2. So from equation 2, COGS is equal to 3 into 38 lakh 56,875. So what is the amount of COGS we get? 1 crore 15 lakh. Clear? Now we have sales, we have COGS, so we can calculate gross profit. So gross profit is equal to sales minus COGS. So calculate the amount of gross profit. 1 crore 81 lakh 50,000 minus 1 crore 15 lakh 70,625. What is the amount of gross profit? So gross profit margin will be how much? Gross profit by sales. Gross profit by sales. How much? What is the gross profit margin? $36.25 percentage. If you have any doubt in this, please do ask. Everyone done till this part? So now what is the third requirement of the question? We have to calculate current asset. So listen, we have only current ratio in this question. Net working capital is not given and nothing is mentioned about current liability in this question. So what we can do is write down third requirement, current asset. In this question we have fixed assets. So the total of the asset side is nothing but fixed asset plus current asset. So fixed asset plus current asset. So this is the total side of the asset side. So the total of the liability side will be debt plus, in this question we have both debt and equity. Debt plus equity plus preference, nothing is mentioned. So assume it is 0. We have current liabilities, right? Now listen, instead of writing this current liability as current liability, we can write it as, in the question it is mentioned current ratio is 1.8 is to 1. So current asset by current liability is 1.8 by 1. So we can write current liability is equal to current asset divided by 1.8. So instead of writing it as current liability, we can write it as current asset divided by 1.8. Is it clear? So now we have fixed asset of 39 lakhs plus current asset is equal to, what is the amount of debt given in the question? 45 lakh plus equity is 30 lakh plus current asset by 1.8. So if we solve this equation, we will get the value of current asset. So what is the value of current asset? Calculate and tell me. So this is 75 lakh and here we have 39 lakh. So 75 minus 39 we get 36 lakh. So current asset minus current asset by 1.8 is equal to 36 lakh. So 1.8 current asset minus current asset by 1.8 is equal to 36 lakh. So what is the amount of current asset by solving this equation? How much? 81 lakhs. 81 lakhs is the value of current asset. Any doubt in this question? Clear? Did everyone understand? Done? Everyone? Any doubt in the calculation of current asset or COGS or gross profit? Clear? So look at question number 49. See, from here onwards, almost all the questions are easy, so you can take most of the questions as homework and I will give you the proper solution for the same. So now listen, question number 49. Equity share capital is 8 lakh, preference share capital 625, debentures 4 lakh, total is 18 lakh 25,000. Additional information is given, profit after taxes 1 lakh 80,000, tax rate is given as 30%. Operating expenses, in this question you need to understand one thing, they have given including depreciation, right? Please ignore this part, assume nothing is mentioned with reference to depreciation. Why? Because this question was taken from I think 2013 question. In this question there was a fourth requirement that was related to some fund flow statement. So at that time, fund flow statement was a part of financial management, but now I think it is there in your accounting syllabus. So depreciation was given for calculating this requirement on fund flow statement. Now it is not there, so assume there is no depreciation. So operating expenses 1.5 times of EBIT. Equity share dividend paid is 15%, market price is 20 rupees. What is the first requirement? Operating leverage and financial leverage. What is the formula? Contribution by EBIT for operating leverage, financial leverage EBIT by EBT. Then we have to calculate cover for preference share dividend and cover for equity share dividend. What is the formula for cover for preference share dividend? What is the, see, they are asking you to calculate preference dividend coverage ratio. For interest coverage ratio, what is the formula? EBIT by interest. Then for preference dividend, it has to be profit after tax by preference dividend, because preference dividend is paid out of profit after tax. Or else I will do one thing, I will just do the second requirement of this question. Third requirement, to calculate earnings yield and price to earnings ratio. So what is the formula for earnings yield? If the term yield is there, the denominator should be market price per share. Numerator, in this case, it will be EPS. Price to earnings ratio formula, MPS by EPS. Right? Clear? Any doubt? So now, for calculating DOL and DFL, or for cover for preference dividend and cover for equity dividend, we need the income statement, right? So in this question, EBIT is not directly given, but EBIT can be calculated using the reverse calculation, right? So write down question number 49. Question 49. So EBIT. Can someone calculate and tell me the EBIT? How much? I will directly do that. You tell me EBIT, EBT and PAT. PAT is directly given. It is 1 lakh 132,600. PAT is 1,82,000. So what is EBT and EBIT? Quickly. Interest is 40,000. How much EBIT? Three lakh rupees. Did everyone get 3 lakh EBIT? EBIT. EBT is 2,60,000. Done. So now what is the first requirement? We have to calculate DOL and DFL. So for calculating DOL, we need okay, I will do that also. I will just show you how to calculate contribution here. So listen, in this question it is mentioned that operating, ignore depreciation, okay, ignore depreciation, operating expenses 1.5 times of EBIT. Listen, contribution minus fixed cost gives us what? EBIT. We know EBIT is how much? 3 lakh. So 1.5 times of EBIT is this fixed operating expenses. This operating expense is nothing but your fixed cost, right? So operating expenses 1.5 times of EBIT. So how much do we get? 4,50,000. So contribution has to be 7,50,000. So what is DOL and DFL? 750 by 3 lakh, 2.5, correct? DOL 2.5 times. DFL 3 lakh by 260, 1 point, how much? $1.15 times. Is the calculation of contribution clear to everyone? Any doubt in that? Contribution. The format is sales minus variable cost is contribution. Contribution minus fixed operating expenses is EBIT. EBIT is 3 lakh. In the question it is mentioned that operating expenses is 1.5 times of EBIT. So take 1.5 times of EBIT. Operating expense we get 4,50,000. So contribution has to be how much? 3 lakh plus 450 we get 7,50,000. Clear? Any doubt in the first requirement? Everyone done till this part? Now look at the second requirement. Second requirement is to calculate preference dividend coverage ratio. So preference dividend coverage ratio. What is the formula? Profit after tax divided by preference dividend. In this case, what is the preference dividend? The profit after tax, it is 1,80,000 divided by preference dividend is how much? 8% of 6,25,000. How much? 15,000. 50. Okay, 50,000. What is the preference dividend coverage ratio? 3.64 times. Is this clear? Any doubt? Now, second requirement itself, we have to calculate cover for equity share dividend, which is nothing but equity dividend coverage ratio. What is the formula? It is, listen, profit after tax minus preference dividend divided by equity dividend. So profit after taxes 1,82,000 minus preference dividend 50,000 divided by equity dividend is how much? Listen, equity share dividend is 15%. 15% of 8 lakh, how much do we get? 1,20,000. So 132 by 120 we get 1.11 times. Any doubt in this? Is it clear to everyone? Do you all understand? Clear? The third requirement you can do by yourself. Earnings yield and price to earnings ratio. Or you want me to solve it? Want me to solve? You know how to do that, right? We have the earnings available to equity. Okay, I'll do it quickly. Listen. So for earnings yield and price to earnings ratio, we need EPS and MPS. MPS is directly given in the question. So we need to calculate EPS. What is the formula for EPS? Net income minus preference dividend by number of outstanding shares. So what is the net income or profit after tax? It is 1,82,000 minus preference dividend 50,000 divided by number of outstanding shares. Listen, total equity capital is 8 lakh and value of face value of one share is 10. So number of outstanding shares will be 80,000. So 1,32,000 by 80,000, 1.65 rupees per share. Clear? So now we have the MPS. So earnings yield is equal to EPS by MPS. So how much do we get earnings yield? 1.65 by 20. We get 8.25%. Next, PE ratio is equal to, what is the formula? MPS by EPS. MPS is 20 by EPS is 1.65. We get 12.65 1 2 times. So did everyone understand till this part? Any doubt? Clear? So look at question number 50. Listen, question number 50 is exactly similar to question number 44. Here we have net working capital and what is this? Net working capital and fixed asset to proprietors fund. So if out of in this question also we have to assume there is no long-term debt because nothing is mentioned about debt capital, none, right? So out of proprietors fund, if 75% is fixed asset, remaining 25% has to be what? Current asset minus current liability, which is nothing but net working capital. So 25% of proprietors fund is working capital. So you can calculate proprietors fund from that. Did you all understand? Clear? So after calculating proprietors fund, you have working capital turnover ratio, you have net working capital. With this you can calculate what? What is working capital turnover ratio formula? Sales by net working capital. So you can calculate sales. So if you have sales, with that you can calculate net profit, right? You want me to do it or you can take it as a homework? Very simple question. Homework, right? So you just write on it as similar to question number 44. So if you have any doubt, you can refer to that. However, I will send you the complete solution of this question. Next, question number 51. It will not take more than 30 seconds to solve this question. DuPont model. What is the formula? Net income by sales into sales by total asset into total asset by equity. So you have all the information. Net income is given, equity is given, asset turnover is directly given. So you don't need to do the second part itself. And net profit margin is also given. So you can calculate it easily. Clear? Any doubt in the 51st question? No. 52nd question. Try to solve it now itself. 52 we will do now. 52nd question, listen. The accountant of Moon Limited has reported the following data. Gross profit is 60,000, gross profit margin is 20%. So with this we can calculate sales. So after calculating sales, listen, total asset turnover is given. So with this we can calculate total asset. Why? Because sales by total asset is 0.3. With this we can calculate total asset. Then net worth to total asset is given. What is net worth? Equity. So we can calculate equity. Then current ratio is given. Liquid asset to current liability. What is this? 1:1. Liquid asset to current liability is nothing but your quick ratio. Then credit sales to total sales is 0.8:1. Average collection period is 60 days. Now listen, why they have given this information relating to credit sales? Because in this question we can't assume the total sales as credit sales. Out of total sales, only 80% is credit, remaining 20 is cash. So only credit sales should be used while calculating average collection period. Clear? Any doubt in this question? You wanted to solve it now or you want to take it as homework? Okay, solve the question quickly. So I'll give you 5 minutes time. Solve it. Done. What is the total balance sheet? 10 lakh. So sales is how much? 3 lakh. Then total asset is 10 lakh. Net worth is 9 lakh. many of you still doing it? Cash is the balance in figures. 60,000, right? Cash. So everyone done? 52. So look at 53rd question. See, 53rd question is similar to the first, question number 40 that we did. Question number 40. Just listen. In this question, they have given the non-current asset, right? Non-current asset to current liability is given, so you can calculate current liability. After calculating current liability, you can calculate current asset. Then non-current asset to current ratio is also given. So if you want, you can start from calculation of current asset as the first working note. If you calculate current asset first, then using current ratio, you can calculate current liability next, right? So using current liability, you can calculate non-current liability. Using using non-current asset itself, you can calculate sales also. So after calculating sales, you can calculate gross profit. Once you calculate gross profit, you will get the COGS. After calculating COGS, you can calculate inventory holding period to calculate inventory, and using sales, you can calculate receivables. Any doubt in this? Clear? Very simple question. There is nothing in this. Okay, inventory holding period is nothing, but what is the formula for inventory turnover ratio? Inventory velocity we discussed, that is inventory holding period. Inventory turnover ratio formula is COGS by inventory into 360. Sorry, not 360, sorry. COGS by inventory. Inventory velocity is equal to 360 by inventory turnover. So we get COGS by inventory. So we can write it as inventory by COGS into 360. Clear? So in this question, assume no change in non-current asset, no depreciation, ignore tax. Right? Why they have given all these things? Because we are supposed to calculate COGS, net profit. The requirement is not to prepare P&L or balance sheet. We have to calculate COGS, net profit, inventory, receivables and cash. That's all. Right? Any doubt? Now question number 54, we will do it. I will do this question. And question number 55 is similar to this question 39 or 40, I'm not, 39, correct. 55 is similar to question number 38. Right, 38. Here we solve direct cost is given and sales is 150% of direct cost. All these things are given. No? Similarly, look at question number 55. It is similar to 38th question. They have given the direct costs. Sales is 150% of direct cost. Similar to that question. And calculation is also very simple. Net profit by sales, return on asset. Return on asset, they have not mentioned whether it is pre-tax or post-tax, but it is always better to calculate post-tax return on asset, then asset turnover and return on equity. So all these formula you know, you can prepare the income statement and calculate these numbers. Clear? Which one? Yeah, the other 50. See, 50 total asset is given 10 lakh rupees, out of which 50% is financed by borrowing debt. So 5 lakh is debt, remaining 5 lakh has to be equity. There is nothing new in this question. In the previous question, 38th also we had a similar kind of adjustment. Total asset was given 8 lakh rupees, 50% borrowed capital, remaining 50% equity. So look at 54th question. Sales for the year, all the sales are on credit basis. Gross profit ratio is 25%. Fixed asset turnover, listen, in this question it is specifically mentioned that fixed asset turnover is calculated based on COGS and not based on sales. So what is the formula for fixed asset turnover? COGS by fixed asset, not sales by fixed asset. Stock turnover based on COGS. Liquid ratio is nothing but quick ratio is given 1:1. Current ratio is 1.5:1. Receivable collection period is 60 days. Reserves and surplus to share capital 0.6:1, which means out of total equity 0.6 is reserves and surplus, remaining 1 is share capital. Capital gearing ratio is 0.5 and fixed asset to net worth is 1.2:1. Requirement of the question is to calculate closing stock, fixed assets, current asset, debtors and net worth. So for calculating closing stock, which formula we can use? Stock turnover. In this question, have they mentioned anything about opening stock? No. So in the denominator, we should take closing stock itself, no average inventory. For calculating fixed asset, we can use fixed asset turnover ratio. For calculating current asset, we can use current ratio. And for debtors, we can use receivable collection period. And for net worth, we can use fixed asset to net worth. Capital gearing ratio will not come into picture. Clear? Any doubt in this question? So let's solve first requirement, closing stock, question number 54. Closing stock. So what is the formula that we need to use? Inventory turnover ratio is equal to COGS by closing stock. What is the inventory turnover given in the question? Inventory turnover is 6 times. But wait, we don't know the COGS now. Wait, we will calculate COGS first. COGS is equal to how many percentage of sales in this case? 75% of sales. What is the sales given? 30 lakh. So 30 lakh into 0.75. What is the amount of COGS? 22 lakh 50,000. So now calculate inventory turnover. Inventory turnover 6 times is equal to 22 lakh 50,000 divided by closing stock. So what is the amount of closing stock we get? 2250 by 6, we get 3 lakh 75,000. Any doubt on this? Clear? Next we have to calculate fixed asset. Which formula we can use? Fixed asset to fixed asset turnover ratio, which is based on COGS. So second requirement, fixed asset turnover ratio is equal to COGS by fixed asset. So fixed asset turnover is 1.5. COGS is 22 lakh 50,000. So fixed asset is how much? 15 lakh, right? Fixed asset is equal to rupees 15 lakh. Clear? Any doubt? Next we have current asset. So how can we calculate current asset in this question? Do we have current liability? No, nothing is mentioned about that. Okay. Using liquid ratio we can calculate a current liability, right? So write down third requirement. Current asset. So quick ratio is given. What is the formula for quick ratio? Current asset minus inventory by current liability. Quick ratio is 1:1. So quick ratio is equal to current asset, we don't know, we have to calculate it, minus inventory. How much did we calculate? 3 lakh 75,000 by current liability. Okay, fine. Write down current liability. So current liability is equal to current asset minus 3,75,000. So we can write it as current asset is equal to 3,75,000 plus current liability. This is nothing but equation 1. We have current ratio given in the question 1.5:1. So current ratio is equal to current asset by current liability. Current ratio is 1.5, which is equal to current asset is equal to 1.5 times of current liability. So current asset is equal to 1.5 times current liability. So this is equation 2. So solve both the equations and tell me the amount of current asset. How much? 11 lakh 25. 3 lakh 75 by 5. Okay, 750 into 1.5. Correct. 11 lakh 25,000. Did everyone understand this one? Clear? That is not the requirement. No? It is not a requirement. Fine. Done, everyone, till this part. Next requirement is to calculate debtors. So how can we calculate debtors? We can calculate it using the receivables collection period. So what is the formula for receivable collection period or debtor velocity? Into debtors velocity is equal to receivables by credit sales into 360. So debtors velocity is how many months? 2 months, which is nothing but 60 days, which is equal to receivables how much? We don't know, we have to calculate. All sales are on credit, so 30 lakh into 360. So this is 6 times 5, receivable is equal to 5 lakh, right? Everyone done? Receivable or debtors is equal to 5 lakhs. Now, one more requirement of the question is to calculate net worth. So, how can we calculate net worth? We have fixed asset to net worth ratio. So, calculate fixed asset to net worth. Fixed asset is how much? 15 lakh. 15 lakh by net worth is equal to 1.2. So, net worth will be 12 lakh 50,000. Everyone done? 12 lakh 50,000 net worth. Everyone done? Now let's say in the same question, if they are asking you to calculate cash, how do you calculate it? We have total current asset. How much? 11 lakh 25,000 is the total current asset. Out of this inventory is 3 lakh 75,000 and debtors is 5 lakh. So remaining 2 lakh 50,000 is the cash. Clear? I am doing this because in this question they are asking you to calculate cash. So how do you calculate it? Current asset minus receivable minus inventory. Clear? Any doubt? 55 you can take it as homework. 56 also very simple, similar to what we did now. You have to prepare balance sheet using all these numbers. I will just tell you how to do it. Stock turnover 7 times based on COGS. Rate of gross profit is given 25%. Sales to fixed asset is 3.5 times. Average collection period is 1.5 months or 45 days. Current ratio 2:1, liquid ratio 1.5 is 1.25. In this question, net working capital is given, current ratio is given. So first working note should be current asset and current liability. Next, net worth to fixed asset is given 1.5 times, reserves and surplus 0.25 times. Long-term debtors, there is no long-term debt in this question. All sales are on credit basis, right? So how can you calculate sales in this question? You will calculate current asset and current liability. With that you can calculate inventory using liquid ratio formula. Once you calculate inventory, you can use stock turnover to calculate what? COGS. Once you calculate COGS, you have gross profit ratio. So remaining 75% is COGS. So 75% of sales is equal to COGS. Clear? Understood? So you can calculate sales like that. So any doubt in this question? And one more thing, reserves and surpluses 0.25 times they have given. No, you will calculate total equity. Out of that, reserves and surpluses 0.25, remaining 0.75 is share capital. Clear? 57 is very simple. They have given the format also. You can take it as homework. 57, take it as homework. 58 we solved yesterday itself. 58 is already solved. So look at 59th question. 59 is slightly different. So I will solve 59. Following are the data in respect of ABC Industries for the year ended 31st March 2022. Debt to total asset ratio is 0.4 and long-term debt to equity is 30%. Gross profit margin on sale is 20%. Receivable period is 36 days. Quick ratio is 0.9. Inventory holding period is 55 days. Inventory holding period is nothing but inventory velocity. COGS 64 lakhs. Now they have given the format of the balance sheet. Total of the balance sheet is 50 lakh rupees on liability side. So on asset side also it should be same 50 lakh rupees. Requirement is to complete the balance sheets and all calculations should be in nearest rupee. Assume 360 days in a year. Now listen, what could be the first working note that you can do in this question? We have COGS, right? With COGS we can calculate sales. With sales we can calculate what? Amount of receivables we can calculate because we have receivables holding period. Or you can do like this also, we have inventory holding period. With this you can calculate inventory first and then you can calculate receivables, right? And then we can see, asset side of this question is very simple. We have all the information given directly. But calculating liability side is slightly difficult. So we will start with the liability side and then we will do the asset side. So listen, debt to total asset is given as 0.4. What is the total asset of the company? 50 lakh, because total liability is 50 lakh. So total asset has to be 50 lakh. So debt to total asset is given as 50 lakhs. Next they have given long-term debt to equity is 30%. So listen, what is the equity of the company? Equity is not 20 lakh because only share capital is 20 lakh. We have to take the reserves and surplus also into account. So what we can do is, listen, debt to total asset is how much? 0.4. So I can say that, so what are the debt instruments we have here? One long-term debt and one short-term debt. So both these items put together we can say 0.4 times of total asset. You're all getting this point, is it clear? So I can say total of these two items is 20 lakhs. 20 lakh is nothing but 0.4 times of total asset. Total asset is 50 lakh. When you take 0.4 of that, you will get 20 lakh. Till this point, is it clear or not? Everyone understood, right? Now, this is 20 lakh and these two things put together it is 20 lakh. Then what has to be the reserves and surplus? 10 lakh is the balancing figure. Understood? Everyone? Any doubt? Now, what is the total equity of the company? 30 lakhs, right? Out of this 30 lakh, long-term debt is 30%. So 30% of 30 lakh will give us the long-term debt. So what will be the long-term debt? 9 lakh is the long-term debt Then what is the remaining accounts payable? 11 lakh rupees. Is this clear? Any doubt in the calculation of liability part? Everyone understood? Now, for asset, we will do the inventory first. Write down working note number 1. Listen, working note number, you want me to show this as separate working notes, or you will go back to your home and you will be able to understand it? Or you want me to show it as separate working notes? Okay, working note number 1, write down. Working note number 1 is total debt. Total debt. So total debt is equal to 0.4 of total asset, because it is mentioned in the question, debt to total asset is 0.4. So total debt is equal to 0.4 into what is the total asset? 50 lakh. So what is total debt? 20 lakh rupees. So you can better write it as current liability plus non-current liability is equal to 20 lakh. Done, everyone? Now reserves and surplus will be the balancing figure, right? So working note number 2, reserves and surplus. Reserves and surplus is equal to total liability minus current liability minus non-current liability. So reserves and surplus is equal to what? Total liability is 50 lakh minus current liability, minus current liability minus non-current liability. Both put together it is 20 lakh. Sorry, how much? We forgot one more thing, equity capital minus equity share capital. So both these things put together it is 20 lakh minus equity capital another 20 lakh. So reserves and surplus is 10 lakh. Clear? Next, working note number 3. Long-term debt. In the question it is mentioned that long-term debt to equity is 30%. So long-term debt to equity is equal to 30%. What is the total equity in this company? Share capital of 20 lakh plus reserves and surplus of 10 lakh. So we get total 30 lakh. So LTD is how much long-term debt? 9 lakh rupees. Clear so far? It's long-term debt is nothing but non-current liability. So current liability is equal to total debt minus long-term debt or non-current liability. So what will be the current liability now? How much? 11 lakh. Any doubt? Clear? So now we are done with all the adjustments relating to liability side. Now do the working note number 4, inventory. So COGS is given in the question 64 lakh and inventory holding period is given 55 days. So what is the formula for inventory velocity? It is inventory by COGS into 360. Inventory velocity is 55 days, which is equal to inventory, we don't know, we have to calculate by 64 lakh into 360. What is the amount of inventory? $77,777. Okay, 778. Next, calculate receivables. So receivables can be calculated using accounts receivable days. So debtors velocity is equal to, which is 36 days, is equal to receivables by, what is the sales? What is the sales? Gross profit margin is 20%. COGS is 64 lakh. So 80% of sales is 64 lakh. What is the total sales? 80 lakh into 360. So we get receivables as 8 lakh rupees. Any doubt? Clear? Did you all understand how it is 80 lakhs? Next. What else we have to calculate? Cash will be the balancing figure. So we can calculate fixed asset. What we can do is, we have the total assets, right? So from quick ratio. We can calculate current asset. From total asset, if we minus current asset, we will get fixed asset. But for calculating current asset, we need current ratio, no? Quick ratio is there, but with quick ratio, correct. With quick ratio, we can calculate current asset. So working note number 6, write current asset and fixed asset. So calculate using quick ratio, calculate current asset and tell me the fixed asset balancing figure. How much? We have inventory, we calculated inventory. So we can calculate current asset using ratio. How much? Current asset minus inventory by current liability. We have current liability here, 11 lakh. So tell me the current asset figures quickly. $19 lakh, 67,777. Current asset, right? 19 lakh, 60 or 60? 67,000. Okay. You can round it to 778 because we have rounded this to 778. No, so the balancing figure will be in thousands. This is also 778, so here also it is 778. So what is the fixed asset now? 50 lakh minus total current asset. Fixed asset is 30 lakh 222. If you have any doubt in this, please do ask. Clear to everyone? So now write down the amount of fixed asset, 30 lakh 62,222. 30 lakh 32,222. 30 lakh 32,222. Inventory how much? 9 lakh 77,778. Accounts receivable 5 lakh 8 lakh. What is the balancing figure? Cash. $40 lakh, 42 lakh. Oh, 1 lakh, no? 39, 40, or it has to be 2 lakh rupees, I guess. Balancing figures. Okay, correct. So any doubt in this question? Clear to everyone? So copy till this point. After finishing this, you can go for a break for 10 minutes. Then we will start with working capital chapter. Settle down, we will start. So listen, the next chapter is working capital management. So within working capital management chapter, we have one chapter on estimating working capital requirements. So that is what we are going to discuss in this chapter. Then we have inventory management, which is similar to second chapter in your cost accounting. Even in your study material, in FM study material, they just mentioned refer chapter number 2 in cost accounting. So whatever you are studying in the second chapter of cost accounting, similar kind of questions will come like EOQ, reorder level, what else? Minimum level, maximum level, all those things, right? And then we have receivables management, which is the next chapter that we are going to discuss. And then we have cash and payables management, which is the last chapter. So now this chapter, working capital management, is all about estimating the working capital. So but first, what is the meaning of working capital? What is working capital? Formula for calculating working capital is current asset minus current liability. But what is the meaning of working capital? For example, let's say you want to start a business and you raised 10 lakh rupees of capital, and you have spent this 10 lakh rupees of capital for land and building 5 lakh and another 5 lakh for plant and machinery. Can you start your business now? Why? Because you have invested your total capital only for the non-current assets. You have not invested any money in the current assets, or you have not invested any capital for running your business on a day-to-day basis. For running your business on a day-to-day basis, you need raw material. So for purchasing the raw material, you need cash. Then you will have laborers working in your factory. For them, you have to pay wages. Then on a day-to-day basis, you will incur some overhead expenses. So you need cash to meet all those day-to-day expenses, right? So the capital that is required for running the business on a day-to-day basis is nothing but working capital of a company. Clear? Any doubt? Now this working capital is calculated as current asset minus current liability. Now what is the purpose of calculating working capital, or the objective of this chapter is, so the company needs working capital, right? So this working capital amount needs to be borrowed from the bank. So the company should know how much amount of money the company should ask as a loan from the bank for financing its working capital. So if you are going to a bank and if you are asking for 4 lakh rupees loan for working capital, the bank will ask, how did you arrive at this 4 lakh rupees? You can't say that this 4 lakh rupees is a random number. For that, there should be a proper scientific way of calculating this working capital. So this chapter is all about calculation of working capital using current asset minus current liability. Basically, we are going to estimate the requirement of working capital in the future. Clear? So what is working capital? Capital required for day-to-day operation. Why this chapter is important? For financing the working capital, the company needs to borrow money from the bank. How much money they should borrow? It should be calculated, and it is calculated using current asset minus current liability. Clear? Any doubt? So now meaning of working capital is, it is the amount of capital required for carrying out the business on a day-to-day basis. Working capital is calculated as the difference between current asset and current liability, right? So you all know what is current asset and current liability, so I don't need to explain it. Now, working capital classified on the basis of value and also on the basis of time. So on the basis of value, working capital can be classified into gross working capital and net working capital. So in ratio analysis chapter also we studied net working capital as current asset minus current liability. Gross working capital is nothing but it is the total of the current assets, right? Then working capital on the basis of time, it can be calculated as permanent working capital and temporary working capital. So let's see what is permanent working capital and what is temporary working capital. Permanent working capital refers to a minimum level of investment in current assets which is essential for the firm to carry on its business irrespective of operations. It is permanent in the same way as investment in firm's fixed asset. It is better to finance this part of the working capital with long-term funds. So what they are saying is, in an organization, irrespective of the seasonality, some amount of money will always be invested in the current assets. So the amount of money that is invested in the current assets for a long period of time is known as permanent working capital. For example, the demand for textile business during festival seasons like Diwali or New Year or Pongal, it will be high, right? During normal seasons, it will reduce. So look at this graph, you will be able to understand it much better. So irrespective of the time, certain amount of working capital is maintained always, or certain amount of investment is always made in the current asset of the company. Now based on seasonality, the working capital requirement will fluctuate. During peak seasons, working capital requirement will be high, and during normal seasons it will reduce. Again during peak seasons it will increase and reduce. So the amount of working capital that is fluctuating is your temporary working capital, and the amount of working capital that remains constant irrespective of the season is permanent working capital. Any doubt in this? So what is important to understand is this permanent working capital is similar to non-current assets. Why? Because it is invested in the business for a longer period of time, similar to non-current assets. So that is what they are saying over here. It is permanent in the same way as investment in firm's fixed asset. Clear? Any doubt what is permanent working capital? Clear? Now temporary working capital refers to the amount of working capital over and above the minimum amount of working capital. So any working capital over and above the permanent working capital is temporary working capital. So temporary working capital will fluctuate based on the seasonal requirements of the company. It may keep on fluctuating from period to period depending upon several factors. It is also called seasonal working capital. Any doubt in this? Clear? What is temporary and what is permanent working capital? Now temporary working capital is like a current asset. It is invested in the business for a short period of time and then it is recovered quickly. But permanent working capital invested in the business for a longer period of time. Any doubt? Did you all understand? Clear? Now working capital in case of a stable firm, it will look like this. The permanent working capital will remain constant and temporary working capital will fluctuate. So this permanent working capital is nothing but minimum amount of investment that must be made in the current asset of the company. On top of that, fluctuations is nothing but your temporary working capital. Clear? So this is working capital in case of a stable firm. But when you look at a growth firm, the permanent working capital itself will increase. Why? Because listen, if a firm is growing, they are going to sell more or less. They are going to sell. Their sales is going to increase. If they want to sell more, they have to produce a lot of inventories. If they are producing a lot of inventories, they need to purchase a lot of inventories, right? So that their inventory is increasing. You're all getting the point. The inventory increases. So many customers are purchasing goods from this particular company. So receivables is increasing because they will purchase on a credit basis. So receivable is increasing. So working capital is nothing but current asset minus current liability. So if a company is producing more and more, their current asset will increase, due to which working capital will also increase. So permanent working capital of growing firm is increasing and fluctuations will happen on top of that. That fluctuation is nothing but your temporary working capital. Clear? Any doubt? Now significance of working capital, listen. Maintaining adequate working capital is not just important in the short term. Sufficient liquidity must be maintained in order to ensure the survival of the business in the long term as well. So what they are saying is, working capital is not only important from short term perspective, but it is also important from long term perspective. Why? Because listen, when business make investment decisions, they must not only consider the financial outlay involved with acquiring machine or new building, etc., but must also take account of the additional current assets that are usually required with expansion of activity. So if you have studied this chapter, investment decision, so in that chapter you will take the incremental working capital into consideration while calculating cash flow. You all remember that? Capital budgeting is done, no? NPV IRR calculation. Yes sir, did it. So, okay, to put it very simple, listen, while studying investment decision chapter also, working capital will come into picture. Why? Because what is important to understand here is, working capital is not only important from short-term perspective, it is also important from long-term perspective. Why? Because while taking any investment decision also, working capital needs to be taken into consideration. So how working capital is important from investment decision, you will understand it while solving questions on investment decisions, right? Now, and one more important thing with reference to this point, I gave you this example, right? If a company is starting business, if they are investing only in the non-current assets of the company, they won't be able to start the business. For carrying out the business on a day-to-day basis, they need to make some amount of investment in the current assets. Now listen, increased production leads to holding additional stocks of raw material and work in progress. So what does it mean? If a company wants to produce more and more quantities of finished goods, they need to purchase more raw materials. So requirement of raw material is increasing. So you will keep more amount of raw material in the stock. And if a company is producing, if a company wants to produce larger amount of finished goods inventories, then work in progress will also increase. Why? Because the production is happening on a continuous basis. So some amount of work in progress will always be there in the production. An increased sale usually means that level of debtors and finished goods inventory requirements will increase. If you are selling more to your customers are purchasing on a credit basis. So your receivable requirement will also increase. A general increase in the firm's scale of operation tends to imply a greater need for working capital. So if a company wants to increase the scale of operation, or if a company wants to increase the production, their working capital requirement will also increase. Why? Because more money is blocked in the form of working capital. Clear? Any doubt? So there is a direct relationship between scale of operation and working capital. If your scale of operation increases, your working capital requirement will also increase. Clear? Any doubt in this? Now, yesterday also while discussing inventory turnover ratio, I told you the objective of working capital management chapter. It has two objectives. What are they? You have to strike a balance between profitability and liquidity, right? So listen, if a company has invested 1 lakh rupee of money in inventory, how this 1 lakh rupees should be understood? Yesterday I told you, no? This 1 lakh rupees should be seen as, this 1 lakh rupees is not just inventory, but this 1 lakh rupees is cash that is blocked in the form of inventory. If this 1 lakh rupee was not invested in the inventory, the company could have invested this 1 lakh rupee elsewhere. Let's say for example, this company could have invested this 1 lakh rupee elsewhere and they could have generated 10% return on that. But now the company cannot generate this 10% return. Why? Because there is an opportunity cost. Why? Because that 1 lakh rupees is blocked in the form of inventory. Similarly, receivables, let's say there is 50,000 rupees that is blocked in the form of receivables. So how the company should see this? This 50,000 rupees is nothing but not just receivables, but it is cash that is blocked in the form of receivables. If the company did not sell goods to their customers on credit, the receivables value would have been 0. So the company would have access to this cash of 50,000. They could have invested it elsewhere and they could have generated return. But now the company cannot do it. Why? Because they don't have access to this cash because it is blocked in the form of receivables. Clear? Now, if a company has higher amount of inventory, what is the advantage and disadvantage? If a company has lesser amount of inventory, what is the advantage and disadvantage? Just tell two advantages and two disadvantages. A company has invested more money in inventory. What is the advantage? It is, first, if a company has invested huge amount of money in inventory, the basic advantage is they will be able to meet the requirements of the customers whenever it is required, because let's say an immediate order is coming for the business. They have sufficient amount of inventory in hand, so they can take inventory from the warehouse and they can sell it to the customer. So they can meet the expectation of customers. Any other advantage of having huge inventory? Since they are meeting the expectation of customers, their sales will increase, so their profitability will increase, so profit will be high. Clear? Any doubt? Now, disadvantages of having more inventory: your liquidity is less. Why? Because you have invested huge amount of money, or huge amount of money is blocked in the form of inventory. You don't have access to that cash, so your liquidity is less. One more major disadvantage is your opportunity cost will be high. Why? Because huge amount of money is invested in the inventory, so you don't have access to cash, so you cannot invest that cash elsewhere. So there is a idle funds, right? So there are some amount of investment which is not generating any return for the company. Is it clear? Any doubt? If a company has lesser amount of inventory, what are the advantages and disadvantages? Liquidity is high. Why liquidity is high? Because they have invested only lesser amount of money in the inventory, so they have access to cash. Any other advantages of having lesser inventory? There is a less risk of theft, obsolescence and damages. If you are keeping inventory in your warehouse, there is a risk of theft. What is obsolescence? The inventory might go out of trend, or there is a risk of damage to that inventory. So here, less risk of damage because of holding lesser inventory. Clear? Any doubt? Now, what are the disadvantages of holding less inventory? Your profitability will be less. Why? Because you won't be able to meet the requirement of your customers as and when required. If a customer is making an order to you, you may not have sufficient amount of inventory to meet their expectation. So, you are not meeting the customer's needs. So, any doubt in these 4 points? Clear? Now, having more inventory has some advantages and disadvantages. Having lesser amount of inventory also has some advantages and disadvantages. Now, which one is better? It is better to have more inventory or less inventory. So, you should not have, it is neither good to have more inventory nor good to have lesser amount of inventory. You should strike a balance between both, right? So, striking that balance between both is nothing but striking a balance between liquidity and profitability. If you are having more inventory, your profitability is huge, but your liquidity is less. If you are having less inventory, your liquidity is more, but your profitability is less. So, so you should not have more inventory, you should not have lesser amount of inventory, you should have optimum level of inventory. What is that optimum level? That optimum level is nothing but your economic order quantity, right? What is economic order quantity? What is the meaning of ordering cost and carrying cost is same, okay. See, economic order quantity is nothing but the amount of quantity that needs to be purchased from the supplier so that the total cost of holding and total cost of ordering and holding the inventory is minimum. If you remember this graph, so this is the total cost line, and your EOQ is the point where ordering cost and holding cost is meeting. So this is EOQ, and total cost is minimum at this level. So the company should have EOQ level of inventory so that total cost of holding and carrying the inventory, total cost of holding and ordering the inventory is minimum. Clear? Any doubt? If you are having a level of inventory that is lesser than equity also, your total cost is more. If you are having a level of inventory that is greater than EOQ also, your total cost is more. So EOQ is the optimum level where total cost is minimum. Clear? So objective of working capital chapter is to strike a balance between profitability and liquidity. So look at this point. Finding a middle ground between profitability and liquidity. So if advantages of holding higher level of inventory is your profitability will be more, right? There will be fewer stockouts, which means you will have sufficient amount of stock to meet the requirement of your customers. Advantage of having lower level of inventory is your liquidity will be more and you require lesser amount of capital. Why? Because you are not investing huge amount of capital in inventory, so you have access to cash. That is the reason why your liquidity position is good, right? This is extreme profitability situation, that is extreme liquidity situation. You have to strike a balance between these two, and that is nothing but economic order quantity or JIT. What is JIT? Just in time. We've studied it. What is just in time? See, just in time is nothing but a company will purchase the inventory only when they get orders from their customers. They will have literally zero level of inventory, right? Which is not there in your syllabus. You have only EOQ, so don't worry. Now, similarly for receivables, you tell me, if a company has higher amount of receivables, profitability will be more or less? Company has higher amount of receivables, profitability will be, or first you tell me this, if a company has higher amount of receivables, the customers are paying on time or they are taking more time to pay the money? They are taking more time to pay the money. So this company is giving a longer credit period to their customers. So profitability will be less. Let me put it in this way. Other companies in the industries are giving 60 days credit, but this company is giving 90 days credit. So receivables for, let's say A and B. Receivables for B Limited will be high. Why? Because they are giving 90 days credit to their customers. So profitability of B Limited will be high. Why? Because they are giving more credit period to their customers. So most of the customers will be inclined towards company B. They will be ready to purchase goods from company B rather than company A. So profitability will be more. But what about liquidity? Liquidity is less. Why? Because it is taking longer time for company B to convert the receivables into cash. This is nothing but debtors velocity. Right? Debtors velocity is relevant in this chapter also. Clear? Any doubt on this? So it is neither good to have higher amount of receivables because your liquidity position is bad. It is not good to have lower amount of receivables because your profitability is less. You should find an optimum credit policy. This is what we are going to deal with in next chapter. So next chapter is all about designing an optimum credit policy, receivables management, right? Cash and cash equivalents. If a company has higher level of cash and cash equivalents, what is the advantage? Payables are honored in time and it improves goodwill, which means a company has sufficient amount of cash in hand. So whenever the company needs to pay the bills, it can pay on time, so which will eventually increase the goodwill of the company in the eyes of the suppliers. Clear? Or you want me to explain it again? Did you all understand this part? If a company has lesser amount of cash in hand, what they can do with that? What they have done? If a company has lesser amount of cash, they have invested that cash elsewhere. So they have made investment in other revenues. So that will generate revenue for the company, right? So if payables are, this will increase the goodwill, and if a company has higher amount of cash in hand, liquidity position is high. What about profitability? Less. Why profitability is less? Because the company has cash in hand. If you are keeping cash in your pocket or if you are keeping cash in your pocket, is it going to generate any revenue for you? No. So the company has cash in hand, which is not going to generate any return for the company. So in this case, there is idle funds. But in this case, liquidity portion of the company is, if a company has invested money in some other revenues, liquidity is less. because they don't have cash in hand, but profitability will be more. Why? Because that the amount of money that you have invested will generate return for the company. So now we have to manage the cash. We should not have excess cash, but at the same time we should not have deficit cash also. We should not have higher amount of cash, we should not have lower amount of cash. We have to manage the cash, we have to calculate the optimum level of cash that needs to be kept on hand. For that we will use techniques like cash budget, and there is something called Baumol model and Miller-Orr model that we will discuss in the last chapter, cash management. Right. Next we have prepayments. Prepayments is nothing but prepaid expenses. Prepaid expenses will be profitable during inflationary periods. Why? Because first, what is inflation? In future, prices are going to increase. So if you are paying the money today, you can pay the expense at a lower cost. But if you are paying in future expenses prices will increase. So you have to pay higher amount of money. So prepaid expenses are profitable in inflationary periods. Is this clear? Any doubt in this? No. If a company is not making any prepaid expenses, it will improve the liquidity of the company. Why? Because they are having more cash in hand. So cost benefit analysis needs to be done, whether it is better to make prepaid expenses or not, whether it is better to make payment in advance or whether it is better to make payment on due date. That analysis has to be made. Clear? Then payables. If a company has, first you tell me, if a company has high amount of payables, it is paying the suppliers on time or it is taking more time to pay the suppliers? It is taking more time to pay the suppliers, right? So the company has access to cash or they don't have access to cash. They have access to cash. So that cash can be invested elsewhere and that will generate return for the company. So here profitability will be, here liquidity, correct, your profitability will be high. But what is the problem here? You are paying late to your customers, your suppliers, your goodwill with the suppliers may be impaired. Here what will happen? Payables are honored in time, which means you are not taking longer time to pay your suppliers. You are paying the money on time. Here liquidity will be less, but the problem is the liquidity will be less. That is the problem. But the advantage is your goodwill with the supplier will be increased. Clear? Any doubt so far? Did you all understand till this part? No. Investing and financing, which means how much to invest in working capital and from where to finance it. Listen, if you want to invest some money, you should have financed it first. For cash outflow, cash inflow should be there. You're all getting the point, right? So we are going to make investment in working capital. From where we are going to finance that, that is also important to understand. Listen, so there are three different types of working capital policy: aggressive, moderate and conservative. So look at this example. Let's say this is a balance sheet. Asset, current asset. Within current asset we have permanent current asset and temporary current asset. So let's say permanent current asset of the company is 300, temporary current asset is 200. This is liability side. Now listen. What is permanent current asset? It is invested in the business for a longer period of time. Can this permanent current asset, can it be converted into cash? See, generally you would have studied that current assets are those assets which can be converted into cash within a period of 1 year. But this permanent current asset will not be converted into cash. Why? Because it is going to be there invested in the business for a longer period of time or for an indefinite period of time. Which means if you are purchasing an inventory, you will not keep that inventory for a longer period of time. That inventory will be sold, but that old inventory will be replaced with new inventory. Clear? So old inventory is replaced with new inventory. So the investment in permanent current asset is same. Old receivables will be replaced with new receivables, which means your old customers will pay the money. Some new customers would have purchased goods on credit. So old receivable is replaced with new receivables. The amount of investment made in receivables will be constant, right? So this permanent current asset will not be converted into cash will not be converted into cash. It is going to be invested in the business for a longer period of time. But what about this temporary current asset? It will be converted into cash after once the seasonal fluctuation ends, what the 200 rupees that you have invested in the current asset will be recovered right at the end of the season. So it will be converted into cash. Now what is the total amount of money invested by the company in the current asset? 500 rupees. That 500 is nothing but gross working capital of the company. What is gross working capital? The total of the current asset. So now the company wants to invest 500 rupees in the gross working capital. For making 500 rupees of investment in working capital, the company needs to finance this 500 rupees. You're all getting the point, right? Investing this 500 is cash outflow. Financing this 500 is cash inflow. So how the company can finance this 500? It has to borrow money from the bank. Now listen. Let's say there is a person called Mr. A. What he is doing is, he needs 500 rupees for financing, for investment in working capital. He takes out current liability of 100 rupees and non-current liability of 400 rupees. Now, within a period of 1 year, how much rupees he has to pay? 100 rupees he has to pay. Within a period of 1 year, what is the amount of current asset that he can recover? Out of this 500 rupees investment made in current asset, he cannot recover that 300. He can recover only 200. So at the end of the first year, he is expecting to recover 200, but he has to repay 100. He is taking less risk or more risk? Lesser risk. Why? Because he is certain that he has to pay 100 rupees and there is a chance that he will get 200 rupees. So his current asset is greater than the current liability. So this person is an aggressive person or a conservative person? Conservative person. So this policy of working capital is known as conservative working capital policy. Now you look at this conservative working capital policy. Where is it? In conservative working capital policy, higher levels of investment will be made in inventory. So the company will have more inventories. Even in this case, current asset is greater than current liability. So in conservative working capital policy, the company will have more amount of investment made in inventories and they will have more amount of cash. They will follow liberal credit policies, which means if other players in the market, if they are allowing 60 days credit to their customers, this particular company will allow 90 days credit to their customers. You are all getting the point. Then higher CAFA ratio. What is CAFA ratio? Current asset to fixed asset ratio, which means these companies, they will invest more on current assets. You can see that higher amount of investment is made in inventory. So inventory level is high. The company has more cash, so cash is high. If they are following liberal credit policy, receivables will be more. So current asset to fixed asset ratio will be higher in this case. Clear? Any doubt in what is conservative accounting policy? Now the positive side of conservative accounting policy is growth in sales value and goodwill. Why? Because why sales value will increase and why goodwill will increase? Sales value will increase because the company follows liberal credit policy. They are giving more credit to their customers. So customers are inclined towards this company. So sales value will be high. Why goodwill is high? Because the company has more cash. So they can pay the suppliers on time. If you look at this example, the company is going to get 200 rupees at the end of the first year. They just need to pay 100 rupees. So the company is going to meet the short-term obligation 100 rupees. So they are going to pay the money on time. So their goodwill will be their goodwill will improve. Clear? Any doubt in conservative working capital policy? Risk or negative part of conservative working capital policy is higher risk of bad debt. Why? Because they are following liberal credit policy. So customers might not pay on time or they might not pay at all. So there is a risk of bad debt and opportunity loss. Why? Huge amount of investment is made in receivables and inventory, and the company has huge amount of cash in hand. That cash is not generating any revenue for the company. That is a idle fund. Clear? Any doubt? Now let's say there is one more person, Mr. B. He is borrowing 400 rupees using current liability and 100 rupees using non-current liability. At the end of the first year, how much rupees he is going to recover? 200. But what is his obligation? 400. So he is an aggressive person or a conservative person. He is an aggressive person. So this type of working capital policy is nothing but a aggressive working capital policy. So in aggressive working capital policy, lesser amount of investment will be made in inventories. The company will follow strict credit policy and they will have lesser amount of cash in hand. So lower current asset to fixed asset ratio, just opposite to conservative policy. In conservative, the company is investing more amount of money in fixed asset. In aggressive, the company is investing lesser amount of money in, not fixed asset. The company is making more amount of investment in current asset in conservative policy. In aggressive policy, the company is making lesser amount of investment in current assets. Advantage, lesser investment. Why less investment? Because lesser investment in what? Less investment in working capital. So money is not blocked in the form of inventory or receivables or any other current assets. That is the advantage. So they can have access to cash. Negative, less growth. Why less growth? Because the company is following strict credit policy. So sales of the company will be lesser than the other players in the market. Why? Because they are following strict credit policy. If other players are giving 90 days credit in the market, this company is giving only 60 days credit in the market. So sales will be less. Clear? Any doubt so far? Did you all understand till this part? Now listen, from here onwards, whatever we are going to discuss is important from exam perspective. There is something called working capital cycle. Working capital cycle indicates the length of time between a company's paying for material, entering into stock, receiving the cash from sale of finished goods. To put it very simple, working capital cycle is nothing but time taken by cash to get converted into cash. Again I am repeating, working capital cycle is nothing but time taken by cash to get converted into cash, which means if you are paying cash today to your suppliers, how long will it take for you to get cash from your customers? So let me give you an example. But before that, wait, one more thing. It is neither good to follow aggressive working capital policy nor good to follow conservative working capital policy. They have to strike a balance, and that balance is nothing but moderate working capital policy. Right? In moderate working capital policy, this person will borrow non-current liability of 300 and current liability of 200. He is matching the current liability with temporary current asset and non-current liability with permanent current asset. Clear? Any doubt? Now look at the operating cycle. So first, what is operating cycle? If you are paying money to your suppliers today, how long will it take for you to receive cash from your suppliers? From your customers. So let's say you are paying money to your suppliers today. You have cash. So by paying cash, let's say you are purchasing raw material. So today, that is here, day 0, you have paid the cash. You have purchased raw material. This raw material will not be entering into production immediately. This raw material will be in the stock, let's say for 30 days. If you are purchasing raw material today, this raw material is entering into production after 30 days only. Then after raw material will be converted into what? Work in progress, right? So the production will happen for, let's say, 15 days. So for 15 days, it is neither raw material nor finished goods. It is in the process of production. Now after 15 days you are producing the finished goods, and this finished goods will not be sold to the customers immediately. Let's say this finished goods is going to be in the stock for another 30 days. You are going to maintain the finished goods in your warehouse for another 30 days. Now this finished goods will be converted into receivables, because mostly you will sell on credit basis to your customers. Let's say the debtors velocity is, the credit period allowed by the company is, let's say 20 days, right? So if you are selling goods to your customers today, they will pay you after 20 days. So you are selling goods to your customers at this point and they will pay you after 20 days. So you are purchasing or you are paying money to the supplier today, that is T0 or day 0. Then for this 30 days, do you have access to cash? No. For the 30 days, raw materials held in stock. So 30 days plus production is happening for another 15 days plus finished goods in the stock for 30 days plus 20 days will be the 20 days the time taken by the customer to pay the money. So if you are paying to your customers today, after how many days you are going to get cash from your customers? How much? 30, 45, 95 days. So when you look at this graph, if you are paying money to your suppliers today, you will get cash from your customers after 95 days. So this cycle is nothing but working capital cycle. Is this part clear? Did you all understand what is working capital cycle? If you are paying cash today, then how long will it take for the cash to get back to you? So cash is paid here, then how long will it take for the cash to get converted into cash? That is working capital cycle. Clear? Any doubt? Now listen. You are giving credit to your customers, right? Similarly, first before that, if you are paying to your suppliers today, your customers will pay you after 95 days. For these 95 days, you have access to cash or not? You don't have access to cash, right? You are giving credit to your customers. Similarly, your suppliers will give you credit to you, right? So your suppliers are saying that if you are purchasing goods from me today, you don't need to pay the money today itself. You can pay me after, let's say you can pay me after 30 days. If you are purchasing goods from me today, you can pay me on the 33. So for this extra 30 days, now you have cash or you don't have access to cash? For this 30 days, you have access to cash or you don't have access to cash? How? You have access to cash. No, because you are purchasing raw material from the supplier, but you are not paying the money today. You are going to pay him after 30 days. So for this additional 30 days, you have access to cash. You are all getting this point. Is it clear? Any doubt in this? Now what is your operating cycle, working capital operating cycle? It is only 65 days. So for 65 days, you don't have access to cash. So working capital cycle is nothing but for how many days you don't have access to cash. Clear? Any doubt in this part? Did you all understand? Clear? Now, for the 65 days you don't have access to cash, but still for running the business on a day-to-day basis for the 65 days, you need cash. Right? So what you will do? You will go and borrow money from the bank. How much you should borrow? That is what we are going to calculate in this chapter, working capital. Clear? Any doubt? Clear, everyone? So look at the formula for calculating operating cycle is, write down operating cycle is equal to receivable days plus, raw material holding days plus work in progress days plus finished goods days plus debtors velocity. Debtors velocity is nothing but receivable days minus creditors velocity, which is nothing but payable days. Payable days, creditors velocity. Everyone done with this? Any doubt? Clear? Now listen. The various components for calculating operating cycle may be calculated as follows. Listen. You don't need to remember any of these formulas because you need to remember only the first two formulas. From this to this is nothing but the formula that we have already studied in the which chapter? Ratio analysis. Here we are calculating receivable collection period. No, that receivable collection is nothing but debtors velocity. So what is the formula for debtors velocity? Receivables divided by credit sales into 360. Here they have taken credit sales per day. The numerator 360 is, they have taken it on the denominator. Credit sales by 360 gives you credit sales per day. You are all getting the point, right? So the last three formulas. What is credit period allowed by suppliers? Creditors velocity. Credit purchases divided by, payables divided by credit purchases into 360. Finished goods storage period is similar to inventory holding period. Inventory divided by COGS into 360. Clear? Any doubt? Now, for raw material storage period, the formula is, listen, if it is a velocity ratio, whether it is debtors velocity, creditors velocity, or inventory velocity, raw material velocity, or work in progress velocity, the numerator should always be a balance sheet figure. The denominator should always be a P&L figure. Right? If it is a turnover ratio, the numerator should be a P&L figure, denominator should be a balance sheet figure. What is the formula for inventory turnover ratio? COGS by inventory. Numerator is a P&L figure, COGS. Denominator is a balance sheet figure, inventory. Right? Opposite for velocity. Numerator should be a balance sheet figure, denominator should be a P&L figure. What is the formula for inventory velocity? Inventory by COGS. Inventory is a balance sheet figure, COGS P&L figure. Clear? So similarly for raw material storage period, numerator should be what? A balance sheet figure. That balance sheet figure is nothing but stock of raw material. Clear? Raw material stock is an asset. It is a balance sheet figure. Divided by, the denominator should be, wait, I will show the formula separately. You write it down. Raw material holding period. Raw material holding period is equal to raw material stock divided by material consumption into 360. Divided by material consumption into 360. Similarly for work in progress holding period, the formula will be what? Numerator should be, what is the balance sheet figure? Work in progress stock divided by, denominator should be the cost of production into 360. Clear? Any doubt in this? Everyone done till this part? Look at question number 1. Question number 1. Calculate net operating cycle period and number of cycles in a year from below information. First requirement is to calculate net operating cycle. What is the formula? Raw material holding period plus work in progress holding period plus finished goods holding period plus receivable holding period minus payabilities. First, raw material inventory consumed during the year is given. How much? 6 lakh. Average stock of raw material is 50,000 rupees. Cost of production is 5 lakh. Average work in progress is 30,000. Cost of goods sold during the year is 8 lakh rupees. Average finished goods stock held is 40,000 and average collection period from debtors is 45 days directly given. Creditor velocity is 30 days directly given. Now, number of days in a year is assumed to be 360 days in a year. Now listen. First, we need to calculate what? Raw material holding period. What is the formula for raw material holding period? Raw material stock by average consumption into 360. Before that, understand the logic behind the formula and then you can solve it. stock, and days. What is the amount of raw material that is consumed during a period of 1 year? Raw material consumed during the year is 6 lakh rupees. So during a 360 days period, we consumed raw material worth of 60 lakh. At the end of the year, we are having a raw material stock of 50,000. So for 360 days, if it is 6 lakh, then for how many days it has to be 50,000? Just cross multiply, you will get the answer. days. So the 30 days is nothing but the raw material holding period. Clear? Did you all understand? Now calculate raw material holding period using the formula. What is the formula? Raw material stock by raw material consumption into 360. So raw material stock is how much? 50,000. By consumption how much? 6 lakh. Into 360, we get how many days? 30 days. Clear? Any doubt? Next, work in progress holding period. What is the formula for work in progress holding period? It is work in progress stock divided by cost of production into 360. So work in progress stock is given in the question 30,000 average work in progress, 30,000. Cost of production is 5 lakh into 360. How many days? 21.6 days. Next we have to calculate finished goods holding period. What is the stock of finished goods? 40,000 divided by cost of goods sold 8 lakh into 360. How much? Finished goods holding period, finished goods stock divided by COGS into 360. So finished goods stock is 40,000, COGS is 8 lakh into 360. How much? How many days? 18 days. Now receivable days is directly given in the question, 45 days. Creditor days is also directly given in the question, 30 days. So receivable days is equal to 30 and payable days is equal to, receivable days is 45, payable days is 30. So calculate the operating cycle. How much? Tell me the working capital operating cycle. $85 days. Everyone done? Everyone done till this part? If you have any doubt, please do let me know quickly. Done? Now the requirement of the question is not to calculate only working capital cycle, but we have to calculate number of cycles in a year. So listen, for 85 days the company does not have access to cash. So for this 85 days the company needs to borrow the money from the bank, right? Now listen, this 85 days is nothing but one cycle. So cycle and days. So one cycle has 85 days. Then 1 year has 360 days means, and how many cycles in a year? How many working capital cycles in a year? 4.2. Is it 4.2? So working capital cycle, sorry, not working capital, number of working capital cycle, number of cycle is equal to 360 days divided by working capital operating cycle. So here it is 360 divided by 85 days, we get 4.24 cycles in a year. Any doubt? Clear? Did you all understand till this part? Now listen. In this chapter we have two types of problem. One is estimation of working capital and the other one is calculation of working capital cycle. This working capital cycle is what we did right now. So this is one type of problem. Then we have estimation of working capital. Working capital can be estimated using two methods or two approaches. First one is total cost basis. Second one is cash cost basis. Right? In your exam mostly they will test you on cash cost basis because total cost basis is very simple. In your POQs almost all the questions are based on cash cost basis only. And there is only one question on double shift. So far double shift question is not tested in your exam. But in your study material also you have only one question on double shift working capital. Right? So for this estimation of working capital, you want me to do the concept analyzer now or after lunch break? Okay, shortly I will start at 1:45. So 1 hour lunch break. So finish it and come quickly. Please come back at 1:45. We will start. Settle down, we will start. So look at the concept analyzer on estimating working capital. So listen, estimation of working capital can be done using two approaches. First one is a total cost approach and the second approach is cash cost approach. So first let's understand what is the difference between a total cost approach and a cash cost approach. So look at this cash costs approach. In practice, another approach may be useful. Another approach is nothing but an approach other than total cost approach may be useful in estimating working capital requirements. This approach is based on the fact that in case of current assets like sundry debtors and finished goods, the exact amount of funds blocked is less than the amount of such current assets. So what they are saying is, look at this example. If we have sundry debtors worth of, let's say, rupees 1 lakh and cost of sales is 75,000, the actual amount of funds blocked in sundry debtors is only 75, and the cost of sundry, and that 75,000 is the cost of sundry debtors, and rest 25,000 is profit. So what they are saying is, for example, let's say the total value of the sundry debtors is 1 lakh. Debtors is nothing but your credit sales. Right, sales amount includes cost as well as the profit. So out of this 1 lakh rupees, 75,000 rupees is the cost of sales and remaining 25,000 is your profit. Now what is the objective of this working capital chapter? We have to borrow money from the bank for financing our working capital. We should know how much money should be borrowed, right? While borrowing money from the bank, the 75,000 is cost, right? We have to borrow the cost or profit or cost plus profit. You have to borrow only the cost. Only the 75,000 needs to be borrowed. This profit is something which you are going to earn by selling goods to your customers. So profit is something which you are already going to get. Then why do you want to finance this 25,000 rupees? So you have to finance only 75,000. Is this part clear? So in cash cost approach, first we have to eliminate the profit because profit should not be financed. Profit is something which you are going to get. So you have to finance only your cost and you should not finance your profit. Is this part clear? Any doubt in this? Now, from here, again some of the cost items are on non-cash basis. Depreciation is a non-cash item, for example. Suppose out of this 75,000, Let's say 5,000 rupees is depreciation, right? See, we need money to finance our working capital. We need to pay money to our suppliers and we need to pay overheads on a day-to-day basis. So paying money to suppliers or paying electricity overheads, all these overheads involves actual flow of cash from one party to the other party. But to whom you are going to pay depreciation? To no one, right? So depreciation is a non-cash item. So out of this 75,000, 5,000 rupees is a depreciation, which is a non-cash item. You don't need that 5,000 actually, because you are not going to pay that 5,000 to anyone. So from this 75,000, that 5,000 needs to be eliminated. So effectively you should borrow only 70,000 rupees from the bank. Clear? Any doubt in this? So the amount of funds or the money that is blocked in the form of debtors or receivable is only 70,000, not 1 lakh rupees. Clear? Any doubt? Did everyone understand? So in cash cost approach, we have to eliminate two things. First, we have to eliminate the profit. Second, we have to eliminate non-cash items like depreciation. Clear? Now look at this concept analyzer. Expected production is 6 lakh units. The company is expecting to produce 6 lakh units. Raw material cost per unit is rupees 10. Wage cost is rupees 2.5 per unit. Overheads cost per unit is rupees 7.5. But that overhead cost of 7.5 per unit includes 0.25 rupees of depreciation. Total cost is rupees 20 per unit. Profit is rupees 5 per unit and selling price is rupees 25 per unit. The company holds 2 months raw material stock. So what is the raw material holding period? It is 60 days. So the amount of raw material in stock is nothing but 60 days of the total raw material consumption for 1 year. Clear? Any doubt in this? Do you all understand? Next, 0.5 percentage of production in work in progress and finished goods will remain in the stock for 1 month. Creditors for material extend 1 month credit, which means your suppliers are extending you 1 month credit period. Debtor credit period is 2 months. You are giving 2 months credit period to your customers. Minimum cash balance is 25,000. Forecast the working capital requirement using total cost approach and cash cost approach. So first let's solve it quickly using total cost approach. Concept analyzer. So listen, for every working capital estimation question, you have to follow a particular format. So first, write down statement showing requirement of working capital, statement showing estimation of working capital, statement showing estimation of working capital. So how working capital is calculated? Current asset minus current liability. So first we have to write the current assets. So what is the first current asset that we have to write? Raw material stock, right? So the first current asset is raw material stock. Now listen how to calculate this raw material stock. During the period, the company is expecting to produce how many units? 6 lakh units. And what is the raw material cost for 1 unit? Rupees 10 per unit. So 6 lakh is the estimated production and raw material cost is 10 per unit. Now listen. When we first, the 6 lakh is your annual production or what? 6 lakh is the annual production. So next year we are expecting to produce 6 lakh units. So what is the annual raw material consumption cost? For 1 unit it is 10. Then for 6 lakh units how much it is? 60 lakhs, right? So the 60 lakh is nothing but the raw material consumed during a 12-month period. Raw material is held in stock for how many months? 2 months. So for 12 months, if it is 16 lakh, then for 2 months, how much it will be? So for that, we have to multiply it with 2 by 12. Is this calculation clear to everyone? Any doubt in this? Now, what is the raw material stock amount? 6 lakh, 60 lakh, 10 lakh. Clear? Any doubt? Now, what is the second current asset that we have to write? We have to write work in progress stock. Now listen how work in progress is calculated. Listen, you can write it later. Listen. What is a work in progress? It is a next stage of the raw material, but a stage before the finished goods, right? Work in progress includes raw material. Work in progress always includes raw material. If nothing is mentioned in the question, we will assume that work in progress includes 100% raw material, which means in the work in progress, 100% of the raw material is employed, right? And work in progress includes wages also. But can we take 100% of wages? Can we say that wages, 100% of wages is employed in work in progress? If we can say that 100% of wages is employed in work in progress, that will become a finished goods. That is not work in progress, right? In this question, nothing is mentioned, so we will make an assumption that work in progress includes 50% of wages. Nothing is mentioned about overheads, so again we will assume 50% of overheads is used for manufacturing the work in progress. Clear? Any doubt in this? So, what is the cost of raw material in work in progress? 10 rupees, 100% of 10. What is the cost of wages in work in progress? 50% of 2.5, we get 1.25. What is the cost of overheads in work in progress? 7.5 by 2. 3.75. Clear? Deduct that we are solving it using total cost approach. In total cost approach, we will not deduct depreciation and profit. In cash cost approach, depreciation will be adjusted. But till this point, is it clear? You have any doubt? Work in progress includes raw material, wages and overheads. Work in progress includes 100% of material, 50% of wages and 50% of overheads. Clear? Now, what is the cost per unit of work in progress? 10 plus 1.25 plus 3.75. 15. So next year we are expecting to produce 6 lakh units of output and cost per unit of work in progress is 15. And for how many months the work in progress is held in stock? It is held in stock for 0.5 months. So multiply it with what? 0.5 by 12. So how much do we get? 1,80,000. Okay, 3,75,000. Next, we have finished goods stock. Now it is a finished goods, which means it includes 100% of raw material, 100% of wages and 100% of overheads. Now nothing is left to manufacture in that. It has become a finished goods. So finished goods should be calculated on total cost. Clear? Any doubt? What is the total cost of the product? 20 rupees. Right? So next year we are expecting to produce 6 lakh units and cost of 1 unit is 20 into for how many months it is expected to be in stock? Finished goods will remain in stock for 1 month into 1 by 12. So what is the amount of finished goods stock? 6 lakh into 20 by 12, 10 lakh rupees. Any doubt in this? Clear? Now listen, what is important to understand is raw material stock includes only the purchase price of raw material. Work in progress includes raw material, wages and overheads. If nothing is mentioned, we will assume 100% material, 50% wages, 50% overheads. For finished goods, it includes 100% material, 100% wages and 100% overheads. Clear? Now, what is the fourth current asset we have? Receivables. So receivables, we are extending 1 month credit period for the customers. So next year we are expecting to produce 6 lakh units, and let's assume we are going to sell all the 6 lakh units to the customers on a credit basis. So 6 lakh into, at what price we are selling the product? 25. Now we are solving estimation of working capital using total cost of goods. So we don't need to eliminate the profit. We can calculate it on selling price. But while doing it using cash cost approach, we will not take 25, but we will take 20. Clear? So 6 lakh into 25 into what is the 1 month? 2 months into 2 by 12. So what is the amount of receivables or debtors? 25 lakh. Next, apart from this, do we have any other current assets? There is a minimum cash balance of 25,000 rupees. So write down 5 cash 25,000. Now, what is the total current asset? Let me write it as A. Total current asset. How much? 375 plus 25. 49 lakh. 49 lakh. So from current assets we have to subtract the current liabilities. So write down next portion of the question, current liabilities. So in this question we have only one current liability, that is creditors for material extend 1 month credit, which means your creditors are giving you 1 month credit. If you are purchasing raw material from your creditors today, you can pay them after 1 month. So from creditors we are purchasing raw material, right? What is the purchase price of the raw material? 10. So 6 lakh units. So write down creditors 6 lakh, and we are purchasing the raw material at a cost of 10, and they are giving us a credit period of 1 month into 1 by 12. How much? 5 lakh. So in this concept analyzer we have only creditors as the current liability, but in questions sometimes we will have outstanding expenses, and apart from outstanding expenses nothing else will be there mostly. So creditors and outstanding expenses will be the major current liabilities that we will have. So what is the total current liability? 5 lakh rupees. Total current liability B 5 lakh rupees. Now total current asset is 49 lakh. Total current liability is 5 lakh. So net working capital is nothing but A minus B. 49 lakh minus 5 lakh, we get how much? 44 lakh is the net working capital for the company. Any doubt in this? Did everyone understand? Clear? Done? Shall we move to the next approach, cash cost approach? So write down statement, same format. Statement showing estimation of working capital using cash cost approach. Write it down. So requirement B is to estimate the working capital requirement using cash cost approach. Same format. First, current assets. So what is the first current asset? We have raw material stock. Now listen, whether it is total cost approach or cash cost approach doesn't matter. Raw material stock will remain the same under both the approaches because raw material does not include any wage expenses or overhead expenses. So raw material stock will not change. So what is the raw material stock under total cost approach? It was 10 lakh. So here also it will be same 10 lakh. 6 lakh into 10 into 2 by 12. We get same 10 lakh. Clear? Any doubt? What is the second current asset? That is work in progress in stock. Now listen, work in process will change. Work in progress includes what? Raw material, wages and overheads. Raw material, how many percentage? If nothing is mentioned, 100%. Wages, if nothing is mentioned, 50%. So this is 10 rupees and this is 1.25 rupees. For overheads, if nothing is mentioned, we have to take 50%. But here the 7.5 rupees of overhead cost per unit includes depreciation of 0.25. So while calculating working capital estimation using cash cost approach, we have to eliminate the depreciation. So from 7.5, if we remove 0.25, how much do we get? We get 7.25. From this 7.25 rupees is the cash costs overhead per unit or overhead costs into cash overhead expenses per unit. But this is 100%. But work in progress includes only 50% of overhead. So 7.25 into 0.5 we get 3.625. Is this calculation clear to everyone? $7.5 is the overhead cost, but that overhead cost includes 0.25 rupees of depreciation. Now we are solving the question using cash cost approach. While solving the question using cash cost approach, only cash expenses needs to be taken into account. Depreciation is a non-cash item. So depreciation it has to be eliminated. So from 7.5 we have to subtract 0.25. On that we have to take 50%. Clear? What are the total costs per unit of work in progress? 10 plus 1.25 plus 3.625? 14 point? Okay, so 6 lakh into 14.875 into work in progress is held in stock for 0.5 months. So how much do we get? 3,71,875. $3,71,875. Clear? Work in progress calculation understood everyone. Next we have finished goods stock. Now finished goods should be valued at total cost, but here this total cost of 20 rupees includes what? 0.25 rupees of depreciation. So from this 20 we have to remove the depreciation, 0.25. How much do we get? 19.75. So finished goods should be valued at 19.75 rupees. Clear? Any doubt in this? So finished goods stock will be 6 lakh into 19.75. Finished goods, it is held in stock for how many months? It is 1 month. So into 1 by 12. How much do we get? 962 500. 987 500. $987 500. Clear? Any doubt in this till this part? Now we have to value debtors or receivables. So receivables are valued at, in total cost approach, receivables are valued at selling price. In cash cost approach, receivables and finished goods are valued at the same total cost per unit. At what price we are valuing this thing? 19.75. Finished goods are valued at 19.75. Receivables should also be valued at 19.75. Why? Because selling price is how much? 25. From in cash cost approach, we have to eliminate two things. First, profit and depreciation. Finished goods does not include any profit, so we eliminated only depreciation. But receivables includes profit as well as non-cash items. So first, from 25, if we eliminate a profit of 5 rupees, we get 20. From 20 rupees, if we eliminate non-cash item of depreciation 0.25, we get 19.75. Is this clear, everyone? Now 6 lakh into 19.75 into 2 by 12. 19 lakh? 75,000. Then we have cash of 25,000, minimum cash balance 25,000. So what is the total current asset? Total current asset A 43 lakh 67. 43 lakh 59,375. Now we have to subtract current liabilities. So we have only one current liability and that will not change, that will remain the same. Creditors. Since creditors are calculated at the purchase price of raw material, which does not include any wages or overheads. So creditors under both cash cost approach and total cost approach will remain the same. So 6 lakh into 10 into 1 by 12. So what is the total amount of creditors? 60 lakh by 12, 5 lakh. So now calculate total liability is 5 lakh. Total current liability 5 lakh. So net working capital A minus B is equal to how much? 38 lakh 59,375. Any doubt in this? Clear to everyone? So based on this format only, we are going to solve all the questions. Everyone done till this part? So now listen, question number 2. It is a question on total costs approach. Very simple. So you can take this as homework because it is not very much important from exam perspective. In exam they will test you on cash cost approach only. So once you solve questions on cash cost approach and when you look at questions on total cost approach, they are extremely easy. So you can take question number 2 as homework. Question number 3, we will leave it for now. We can solve it later because it is slightly different. Question number 4, listen. Aneja Limited, a newly formed company. Now listen, in this chapter we will have two types of companies. One is a newly formed company and the other one is a existing company. If it is a newly formed company, they don't have any opening stock of raw material, opening stock of finished goods and opening stock of work in progress because it is a newly formed company. So now only this is the first year of operation. So they don't have any opening stock. Swaneja Limited, a newly formed company, has applied to a commercial bank for the first time for financing its working capital requirements. The following information is available about the projections for the current year. Estimated level of activity is 1,04,000. Next year they are expecting to produce 1,04,000 units of finished goods plus 4,000 units of work in progress. So next year their estimated production is 1,04,000 units, and they are also expecting to have 4,000 units of work in progress, which is neither raw material nor finished goods. It is in the process of production. Estimated cost per unit is given: raw material 80 per unit, wages 30, and overheads exclusive of depreciation is 60, which means this overhead of 60 rupees does not include depreciation. So we don't need to adjust it. It is already a cash cost. Total cost is 170 and selling price per unit is rupees 200. Raw materials in stock average 4-week consumption, which means raw material holding period is 4 weeks. Work in progress, assume 50% completion stage in respect of conversion cost. What they are saying is, one more thing, material issued at the start of the processing, which means as far as work in progress includes what? Material cost, wage cost and overheads. Work in process is 50% completion stage in respect of conversion cost. Conversion cost includes what? Wages and overheads. So for wages and overheads, work in progress includes 50% of labor cost and 50% of overheads. But materials are issued at the start of processing, which means it includes 100% material. Total materials are employed into the work in progress, but only 50% of wages and 50% of overheads have been worked on them. Remaining 50% is yet to be done. Clear? So for work in progress, we will take 100% raw material, 50% wages and 50% overheads. Finished goods in stock 8,000 units is given. Now, in this question, work in progress is given in terms of units. Finished goods is given in terms of units. So you will not find finished goods holding period and work in progress holding period in this question, because at the end of the year we are having 4,000 units of work in progress and 8,000 units of finished goods. So the holding period is not necessary in this question, because at the end of the year, first let's say 1 lakh units, okay, let's check 1,20,000. 1,20,000 units is the production, estimated production. Next year you are expecting to produce 1,20,000 units. Let's say your finished goods holding period is 2 months. So what will be the finished goods stock? 1,20,000 into 2 by 12. So how many units you get? 20,000 units. So in this question, this units itself, it is already calculated and given for you. So this holding period is not required in this question. You are all getting the point. So they have given the finished goods in terms of units itself. So holding period will not be available in this question. Similarly, work in process also. Clear? Understood? Credit allowed by suppliers is average 4 weeks and credit allowed to debtors is 8 weeks. Lag in payment of wages 1.5 weeks. So this is an asset or a liability. Lag in payment of wages. You are paying it in advance or you are making a delayed payment. Delayed payment. So it is nothing but your outstanding wages. So it will be shown on the liability side. Clear? Cash at bank for smooth operation is 25,000, which is a minimum cash balance is 25,000. Assume that production is carried on evenly throughout the year, 52 weeks, and wages and overhead accrue similarly. What they are saying is, we have to take 50% of wages and 50% of overheads for work in progress, because it is accrued evenly. Means, let's say 1,20,000 is the total wage cost for the year. One year has 12 months, right? So every month you are expecting to incur 10,000 rupees of wages. It is accrued evenly throughout the year. All sales are on credit basis only. Calculate the working capital requirement of the company. In this question, nothing is mentioned whether we have to use cash cost approach or total cost approach. If the question is silent, it is better to use cash cost approach, right? So now question number 4. Question number 4. Working note number 1. Write down working note number 1. Working note number 1. Stock of raw materials. Stock of raw materials. So during the period, how many units we have produced? We are expecting to produce 1,04,000 units. For 1 unit, what is the raw material cost? 80,000. So, raw material in finished goods is equal to, why I am writing it as finished goods, you will understand. So, raw material finished goods is equal to 1,04,000 units we are expecting to produce, and cost for 1 unit of raw material is 80 into what is the holding period? Raw material holding period is 4 weeks into 4 by 52. Here please don't take 4 by 12 into 4 by 52. So what is the stock of raw material in finished goods? 6 lakh? 6,40,000. Okay. 6,40,000. Clear? Any doubt? Now listen. Raw material is included only in the finished goods. No, raw material is also included in the work in progress. What is the work in progress here? 4,000. So raw material is employed 100% in the work in progress. Work in progress includes 100% of raw material, right? So the 6,40,000 is nothing but the raw material that is consumed for producing 1,04,000 units of finished goods. Right, but raw material is used not only for finished goods, it is used for work in process as well. So, raw material in work in process how many units of work in process? We are estimating 4,000 units, and material cost is 80 into 4 by, sorry, how many months? No, here, listen. Raw material holding period is how much? 4 by 52. 4 by 52. How much do we get? 24,000. So what is the total raw material stock? How much? Any doubt in this? Clear? Did you understand the difference between the 6,40,000 and 24,615? What is 24,615? The amount of raw material consumed for producing 4,000 units of work in progress. Clear? Any doubt? Now write down working note 2. Working note 2. Stock of work in process. So work in process includes what? Raw material cost 100%, wages 50% and overheads 50%. So stock of work in progress includes raw material. So what is the unit of work in progress? 4,000 units into 80. So we get how much? 3,20,000. Is this calculation clear? 4,000 into 80. Work in progress includes 100% of, okay, let me put it in this way. 4,000 into 80 into 100%. Because we have produced 4,000 units of, we are expecting to have 4,000 units of work in progress at the end of the year. And that work in progress includes 100% of the raw material. For 1 unit of work in progress, the cost is 80 per unit. So for 4,000 into 80, we get 3,20,000. 20,000. Clear? Any doubt? Now why we are not multiplying it with work in progress holding period? Because it is already solved and given for us. This 4,000 units is nothing but work in progress stock itself. It is directly given. Clear? Any doubt? Now work in progress includes wage cost, wages. So how many units of work in progress? 4,000 into what is the wage cost? 30. Can we take total 30 rupees? No, we have to take only 50% of it. So 30 into 50%. How much do we get? Next, overheads. We have 4,000 units of work in progress and cost per unit is 60 into how many percentage? 50%. How much? 1,20,000. So total work in process stock is equal to 5 lakh rupees. So far clear? Any doubt till this point? If you have any doubt in the calculation of work in progress, please do let me know. Clear? Any doubt? Understood? So now listen. For all the questions based on cash cost approach, we have to prepare something called cash cost sheet. If we are preparing that cash cost sheet, preparing the working estimation of working capital statement will be extremely easy. So write on working note 3. This working note will be required almost in all the questions. Working note 3, cash cost sheet. So what is the starting point of a cost sheet? You will start it with opening stock of raw material plus purchases minus closing stock. You will get what? Raw material consumed. So here we will start with raw material consumed directly. Raw material consumed. Now listen. This part is extremely important. Listen. Raw material is consumed in two things. First one is finished goods as well as in work in progress. How many units of finished goods we are producing? 1,04,000 into what is the cost per unit? 80. Till this part clear? Plus raw material is also consumed in work in progress. How many units? 4,000 into 80. So what is the total raw material consumed during the period? 86,40,000. Now listen, this raw material is consumed over a period of how many years, how many months or how many weeks? 52 weeks. What is the raw material holding period? 4 weeks. So for 52 weeks, if you are consuming 86,40,000 40,000 rupees of raw material, then for 4 weeks, what is the stock? Into 4 by 52. That is the stock of raw material we calculated in first working note. You are all understanding the point. Clear? Any doubt on this? So next, after calculating raw material consumed, to that we will add what? Direct wages, right? So wages. See, listen here, many people will commit the mistake. Wages is consumed in finished goods as well as in work in progress. So 1,04,000 into what is the wage cost? 30, right? 30. We can take this plus for work in progress we will take 4,000 into 30 into 50%. So please don't forget to take that 50%. So how much do we get wages? 31,80,000. Next we have to take overheads. So overheads is included in both finished goods as well as work in progress. So overheads, how much cost per unit? 60. So for finished goods you have to multiply it with 60, but for work in progress you should be multiplying it with how much? 30. So 1,04,000 into 60 plus 1,04,000 into 60 into 50%. So how much you are getting? Oh sorry, work in progress is 4,000. 63 lakh 60. What is the total? How much? 1 crore? 1 crore 81 lakh 80,000. So what is this 1 crore 81 lakh 80,000? Prime cost. You have added overheads, then how this can be a prime cost? This is nothing but your cost of production, but you cannot call it as cost of production because we have to adjust it for work in progress. So this is nothing but your gross factory cost or works cost. Gross factory cost 1 crore 81 lakh 80,000. Any doubts in this so far? Now from gross factory cost, if we add opening stock of and subtract closing stock of dash, we will get cost of production. Work in process. What is the opening stock of work in process? Opening stock of work in process? 0. Why? Because it is a newly formed company. So opening is 0. Minus what is closing stock of work in process? We calculated it in working note 2. 5 lakh. So what is the cost of production? 1 crore 76 lakh 80,000. Any doubt in this? Till this part clear to everyone? Understood? Now listen. To cost of production, we have to adjust opening stock of finished goods minus closing stock of finished goods. What do we get? What do we get? Cost of goods sold. What is the opening stock of finished goods? It is 0. Now how to calculate closing stock of finished goods? How much? How much? Listen, in this question, closing stock of finished goods is directly given 8,000 units, right? Finished goods should be valued at what cost? Last concept analyzer also we did it. Total cost. What is the total cost? 60. 170. So 8,000 into 170. That's all. That is the cost of, closing stock of finished goods. 8,000 into 170. How much do we get? 13 lakh 60,000. What is the cost of goods sold? 1 crore 63 lakh 20,000. Clear? Any doubt so far? Now listen, this is not the end. So in this question, they have not mentioned anything about selling, administration and distribution expenses. But in few questions it will be mentioned, selling, administration and distribution expenses. To COGS we have to add selling, administration and distribution expenses, here it is 0, and if we add it we will get cost of sales. Sure, in this case it is 1,63,000, 20,000 itself. Everyone done till this part? Now let me tell you what is this 1,63,20,000. This is what cost of sales, right? During the next period, how many units the company is expecting to produce? 1,04,000 units they are expecting to produce. At the end of the year, they are expecting to have 8,000 units as closing stock of finished goods, right? So, what is the amount of how many units they have actually sold? 96,000. So 1,04,000 is what they are producing, minus 8,000 is still with them at the end of the year. So 96,000 they are planning to sell. What is the cost per unit? 170. Multiply 96,000 with 170, you will get 1,63,20,000. So that is this number. Clear? Any doubt in this part? Did everyone understand? Right? Now listen. During the period the company produced 1,04,000 units, right? So 1,04,000 units, cost for producing one unit is 170. So multiply 1,04,000 into 170, how much do we get? 1,76,80,000, right? This 1,76,80,000 is the cost incurred for producing 1,04,000 units. But this total cost will not be debited to the P&L account. Why? Because matching or accrual concept of accounting. You have to recognize expense only to the extent of you have recognized revenue. In this case, for how many units you are recognizing revenue? 96,000. So you should recognize expense only for 96,000. What is the cost of 96,000 units? So from this total cost minus 1,63,20,000, how much you are getting? That 13,60,000 is nothing but your cost of finished goods, the cost of the remaining 8,000 units. Clear? Any doubt? Everyone, once again. 1,04,000 you are producing. The cost of production is 1,04,000 units you produced. The cost of 1,04,000 units is, one unit it is 170. So 1,04,000 into 170 you get 1,76,80,000. So I am writing it as 17,680. Clear? Out of this we have sold only 96,000 units, right? So 96,000 units sold. What is the cost of 96,000 units? 96 into 170 we get 16,320, which is nothing but the cost of sales. So this 16,320 will be debited to the P&L account. Now closing stock will be there on the credit side of P&L account. Closing stock is there on the credit side of P&L account, right? So we have 8,000 units of closing stock. So 8,000, out of, from this 17,680 minus 16,320 we will get how much? 1,360. That 1,360 is nothing but closing stock. Clear? So now we have calculated stock of raw material, stock of work in process, stock of finished goods also. Finished goods stock is calculated over here. Next we have to calculate what? Stock of debtors, or in stock, no, right. Write it as debtors, working note 4, debtors. So usually debtors are calculated at what cost? So listen, let me tell you one thing. Usually, okay, you take the debtors velocity formula. Debtors velocity is equal to receivables by credit sales into 360, right? Here debtors velocity is given as how many days? 8 weeks. Right, now listen. While calculating ratios, we will use credit sales on the denominator. But now we are estimating the working capital requirement. from sales, sales includes what? Profit. That profit needs to be eliminated. So what we have to do? We have to calculate receivables on cost of sales. Clear? Understood? So what is the total cost of sales? 1 crore 63 lakh 20,000, because this cost of sales plus profit will give you sales. So sales minus profit is cost of sales into how many months? So how many weeks it is? 8 weeks. So into 8 by 52. How much we are getting? Debtors. No way. 25 lakh. Did you understand the calculation of debtors? You can calculate it using sales also, but the problem is that sales figure includes profit. We are doing it using cash cost approach. Eliminate the profit. Any doubt till this part? Clear? So now next, cash is directly given in the question, 25,000. So we are done with all the current assets. Raw material done, work in process done, finished goods done, debtors done, and cash is given. So next we have to do the current liability. Write down working note number 5. Current liability is nothing but we have only two current liabilities. One is creditors, and we also have what? Outstanding wages. First, creditors. From creditors, what we are purchasing? Raw materials, right? But listen. While calculating creditors velocity, what is the formula? Payables by credit purchases into 360. Do we have credit purchases here? No. So that is something which we need to calculate. So listen. If it is a newly formed company, whenever you come across here, say you can see it is a newly formed company. Third question also you will be able to see. A newly commencing business. So whenever it is a newly commencing business or a newly formed company or a new project, credit purchases needs to be calculated. Right? If it is an existing company, so listen, fifth one is an existing company. This is relatively very simple. If it is a new company, we have to make lot of adjustments there. If it is an existing company, it is quite straightforward. If it is a new company, please keep in mind that credit purchases has to be calculated. If it is a new company, it is not required. Why it is not required? We will discuss it in fifth question. But now, credit purchases needs to be calculated. So, let me tell you how to calculate credit purchases. Please remember this one format. Raw material consumed plus closing stock of raw material. So what is the total raw material consumed during the period? No, 86 lakh something. 86 lakh 40,000. This is from working note number 3. What is the stock of raw material we are having in hand? From working note number 1. Stock of raw material 6 lakh 64,615. What is the total? Then listen. For consuming this raw material, we should have purchased it. So we have purchased raw material worth of 86 lakh 40,000 and we have consumed it in both finished goods and work in progress. Apart from consumption, we have another 6 lakh 64,615 rupees of raw material in hand. So totally we have purchased how much? So total purchases is equal to, add 90. So far clear? Any doubt in this? Did you all understand? Did you all understand the logic behind this formula? No. Raw material consumed means we have consumed it in both finished goods and work in progress. To consume something, we have to purchase something. So this 86 lakh 40,000 is the amount of raw material purchased. You got that point. We purchased raw material worth of 8640 and we have consumed it in both finished goods and work in progress. Apart from consumption, we have another 6,64,615 rupees of raw material in hand, which is not consumed. It is there in the closing stock. If it is there in your closing stock, means you have purchased it. So your purchases includes consumption plus purchases. Or else let me put it very simple. Listen. What is the formula for calculating raw material consumed? Opening plus purchases minus closing is equal to raw material consumed. We know raw material consumed. We have to calculate what? Purchases. So raw material purchases is equal to raw material consumed plus closing stock minus opening stock. In this case, opening stock is 0. So we are taking only closing stock. Understood? Got it? So next we have creditors for wages or outstanding wages. Working note number 6. Outstanding wages. Now wages is consumed in both WIP and finished goods. So total wage expense for the year is equal to wage expense, or else let me write it in this way: wage expense or else wages incurred for WIP and finished goods. Wages incurred for work in progress and finished goods. So what are the wages incurred for finished goods? 1,04,000 into 30. How much? 31,20,000. What are the wages incurred for work in progress? 4,000 into 30 into 50%. How much? 60,000. So how much do you get? Total 31,80,000. Clear? So this 31,80,000 is the amount of wages incurred during a period of how many weeks? 52 weeks. So outstanding wages will be how much? 31,80,000 into how many weeks? 1.5 weeks. So into 1.5 by 52. So how much do we get? How much? 90,000. $91,731. Here we calculated only total credit purchases. We did not calculate the creditor itself. Listen. So during the period of 52 weeks, we purchased raw material worth of 93,04,615. What is the credit period allowed by the supplier? 4 weeks. So what are the creditors? Creditor is equal to 93,04,615 into 4 by 52. How much? Seven. Everyone done till this point? Any doubt in these working notes? Clear? Now listen. You have to follow the same format, statement showing the estimation of working capital. But here listen, since we are practicing it, let's not waste time. Just write it down. Net working capital is equal to current asset minus current liability. While practicing questions, when you have time, you follow the format and practice it. But now, just add all the current asset minus the two current liabilities and tell me what is the net working capital. Quickly tell me what is the net working capital. How much? Please don't forget to add the cash. Cash is given 25,000. Please don't forget to add the cash. What is the net working capital? How much you are getting? What is there? You just need to add all the current asset and subtract the current liability. 42 lakh something. So 6,64,615 plus work in progress 5 lakh. Finished goods from here 13,60,000 plus debtors 25,10,769 plus, so that's all, minus creditors 715. Oh, we have to add cash, sorry, plus 25,000 cash minus creditors 715,740 minus 91,731. 42,52,913. Everyone got it? 42,52,913. Done. Any doubt in this question? Clear? Everyone done till this part? Because nothing is mentioned, we have to do cash cost. Cash cost is the, what to say, a better way of doing it. In total cost approach, we are including depreciation and profit, which you don't need to finance. So it is better to always use cash cost approach. Almost, except question number 2, all the questions are based on cash cost approach only. You got it? 42,52,913. So look at question number 5. Listen, question number 5. The following annual figures relate to XYZ company. Now, it is an existing company or a new company? It is an existing company. It is not mentioned that it is a newly formed company, right? So write down, before starting this question, write an assumption. If it is an existing company, 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 it is assumed that it is assumed that opening stock of raw material is equal to closing stock of raw material. Opening stock of work in process is equal to closing stock of work in process. Then opening stock of finished goods is equal to closing stock of finished goods. Clear? Any doubt? If it is an existing company, we are assuming that opening stock is equal to closing stock of all the inventories. So everyone done? Shall we start with the question? So sales for 2 months credit period, it is given 36 lakh. Material consumed is 9 lakh rupees. And suppliers extend 2 months credit period. Wages 1 month lag in payment, so there is an outstanding wages in this case. Cash manufacturing expenses are paid 1 month in arrear. So total cash manufacturing expenses 9,60,000. So here since it is a cash manufacturing expense, it includes depreciation or excludes depreciation? It excludes depreciation because depreciation is a non-cash item. Admin expenses 240, sales promotion 120. The company sells its product on gross profit at 25%. So from sales, gross profit is 25%. Depreciation is considered as a part of the cost of production. Listen. In this question, they have given depreciation just to confuse you because cash manufacturing expenses directly given in the question. So depreciation has got nothing to do with this. Suppose let's say generally they have given manufacturing expenses, then you have to remove depreciation from that. But here only cash manufacturing expenses given, so depreciation is irrelevant. Clear? Any doubt? Except depreciation, all of the other manufacturing expenses. Manufacturing expenses which involves actual flow of cash from one party to the other party. But depreciation is a non-cash item. You are not paying it to anyone, right? Understood? Clear? It keeps 1 month stock of raw material and finished goods. So raw material holding period is also 1 month and finished goods holding period is also 1 month. And a cash balance of 1 lakh rupees. Assume 20% safety margin. What is the safety margin? We will discuss later. Compute working capital requirement of the company on cash cost basis. In this question, they have asked us to ignore work in process, right? If it is a cash cost question, it is always better to prepare a cash cost sheet, right? So listen, if it is a newly formed company, the first requirement will be to calculate stock of raw material. Second working note, stock of work in progress, what we did in previous question, because it was a newly formed company. And third working note is to prepare cash cost sheet. If it is an existing company, you can directly start off with cash cost sheet. So write down question number 5, working note 1, cash cost sheet. So cash cost sheet should start with what? Raw material consumed, so what is the raw material consumed given in the question? 9 lakh rupees. Then we have to add wages. What are the wages? 7 lakh 20,000. Then we have to add cash manufacturing expenses, nothing but overhead expenses. So cash, or you can write it as just manufacturing expenses. Manufacturing overheads or manufacturing expenses. So what is the total manufacturing expense? 9,60,000. So when we add all these things, what do we get? Gross factory cost. How much? 1620 plus 960. So 25 lakh 80,000. 25 lakh 80,000. Right, now listen. Just listen, don't write anything. From gross factory cost, what do we need to adjust? Opening stock of work in process minus closing stock of work in process, we have to adjust. But since it is an existing company, we know that opening stock of work in process is equal to closing stock of work in progress. Actually, in this question, we don't have work in process itself, but for your understanding, I am telling. Let's say opening is 1 lakh, then closing is also 1 lakh. Don't write anything, just listen. Closing is also 1 lakh. So it will get cancelled out, and COP is equal to gross factory cost. We did a similar kind of question in ratio analysis also, 42nd question. We made a same assumption and we assumed that factory cost was equal to COGS, right? So here, since opening stock of work in progress is equal to closing stock of work in progress, gross factory cost is equal to cost of production. So gross factory costs, what is cost of production? Same, 25 lakh 80,000. So from cost of production, what do we need to adjust? Opening and closing stock of finished goods. Both are same in this case. So cost of production is equal to cost of goods sold. Not cost of sales, cost of goods sold. Cost of goods sold, that is also equal to 25 lakh 80,000. Now listen, from cost of goods sold, what do we need to add? To cost of goods sold, what do we need to add? Selling, admin and distribution expenses. In this question, admin expense 2 lakh 40, sales expense 1 lakh 20. So add sales expense, then admin expense. Sales is 120 and admin 240. Now what is COGS plus sales plus admin expense? What do we get? Cost of sales. How much? 3 lakh 60 means, so 29 lakh 40,000. So now everyone understood till this part? Clear? Now listen. Using raw material consumed, we can calculate stock of raw material. Using cost of production, we can calculate stock of work in progress, but here ignore work in progress they have given. So ignore it. Using COGS, we can calculate stock of finished goods. Using cost of sales, we can calculate receivables or debtors. That is what we did in the previous question also, right? So write down working note number 1. Stock of raw material. So stock of raw material is equal to, what is the raw material consumed during the period? 9 lakh into what is the raw material holding period? This 2 months is credit period. Here it is given, it keeps 1 month stock of each raw material and finished goods. Raw material holding period is also 1 month, finished goods also 1 month. So 9 lakh into 1 by 12. How much? 90 by 12 means 75,000. Clear? Next, working note 3. stock of finished goods. The stock of finished goods can be calculated using COGS. So what is the COGS? 25,80,000. The stock of finished goods is equal to 25,80,000 into holding period is 1 by 12. So how much? So next we have debtors, working note 4. Debtors can be calculated using cost of sales. 29,40,000 into, what is the credit period given by the company? 2 months into 2 by 12. How much do we get? Done. Next, we are done with almost all the asset. Cash is given 1 lakh rupees. Fine. Then we have to calculate the current liability, creditors, right? So listen, if it is a newly formed company, we have to calculate credit purchases. Don't write, just listen. What is the formula for calculating credit purchases? Plus closing stock minus opening stock of raw material. Right? In this case, we are assuming opening stock of raw material is equal to closing stock of raw material. So they will get cancelled out. So raw material purchase is equal to raw material consumed. So what is the raw material consumed? 9 lakh. Clear? Any doubt in this? Did you all understand? So working note 5, creditors. Here raw material consumed is equal to raw material purchases. So it is 9 lakh into what is the credit period extended by the supplier? It is 2 months into 2 by 12. How much do we get? 37,500. Sorry, 1,50,000. 1,50,000. Clear? Any doubt? So now apart from this, do we have any other current liabilities? Apart from creditors, we have wages, outstanding wages, wages paid, not only wages. We have wages, cash manufacturing expense and admin expense. Listen, all these 3 expenses are paid 1 month in arrear. Right? Oh, wait. Correct. If all these expenses are paid in 1 month arrear, or there is a lag in payment of 1 month for all 3 expenses. So what we can do is this plus this plus this. We can add everything and we can divide it by 12. So we will get the total outstanding expense. Clear? Did you all understand? So working note number 6, outstanding expenses. Now here we can do that because the lag in payment is 1 month for all the 3 expenses. If it is different, then we can't do it. Outstanding expenses. So how much? 720 plus 960 plus 240. This is 12 lakh plus 19 lakh 20,000. 19 lakh 20,000 into 1 by 12. How much do we get? 1,60,000 is the outstanding expense. Clear? Any doubt? Next we have sales promotion expense. Listen, this is paid quarterly in advance. So it is a prepaid expense. Prepaid expense is a current asset or current liability? Current asset. So write it down. Working note 7, prepaid expense. prepaid expense. So 1,20,000 is the total expense and it is paid. It is paid quarterly in advance. So what will be the prepaid expense? 1 year has how many quarters? 4 quarters. So 1,20,000 into 3 by 12 or 4 by 12? 3 months we advance, correct. Into 3 by 12. Or 1 year has 4 quarters, so 120 divided by 4. So how much do we get? 30,000 is the prepaid. Clear? Did everyone understand till this part? Now listen, net working capital is equal to current asset minus current liability. So listen, the total of current asset includes, let's start from working note 1, just do it along with me. So stock of raw material is 75,000 plus no work in process plus finished goods 2,15,000 plus debtors how much? 4,90,000, and before prepaid expense we have cash also, cash worth of 1 lakh plus 1 lakh plus prepaid expense of 30,000. 9,10,000 total asset. Everyone done? Now listen, we have 20% margin also. I'll do one thing. Write it like this: total asset in total current asset. How much? 9,10,000 minus total current liability. What is the total current liability? 160 plus 150. How much? 3,10,000. So what is working capital? 6 lakh. Now listen. So the company has to borrow 6 lakh rupees from the bank for financing its working capital. But in the question it is mentioned that assume a 20% safety margin. So on top of this we have to add plus 20% of 6 lakh for safety margin. Plus 20% safety margin, we get 1,20,000. So net working capital requirement is 7,20,000. Clear to everyone? Did you all understand? See, the company has to borrow 6 lakh rupees, but sometimes some contingencies they may require. Contingency means for some unforeseen events they may require even more cash. So they are, for example, let's say your customers have promised to pay you in how many days? 60 days they have promised to pay. 2 months credit you have given. But sometimes they may take extra 30 days. Let's say they are paying you on 90th day. So for extra 30 days you don't have cash. But for those 30 days you need cash to run the business. No? So on a contingency basis you are borrowing extra 1,20,000 to meet unforeseen expenses. Clear? Any doubt? Everyone done with this? Now listen, question number 6. It will take a lot of time to solve. It is a study material question. These kind of questions will not come in your exam because they are asking us to calculate projected P&L account for 2 years and working capital requirement for 2 years. These kind of questions will not be tested. But a similar kind of question is there in your past year question paper. It was question number 14. Right, but here they are not asking us to prepare a P&L account at all. That is not a requirement. They are not asking us to prepare working capital estimate for 2 years. Right. So I will solve this question in class. We will do this question. Once you solve this question, you will be able to solve the sixth question by yourself. It is a similar kind of question, right? It is easy, but it will take a lot of time. There is no point in spending 1.5 hours in a question which is not going to be tested in your exam. So for now, we will skip 6th. 7th question, we will do it tomorrow. It is a double shift question. We will do this tomorrow. Now we will focus on similar kind of questions what we did today, right? So from question number 8, almost all the questions are your past year questions only. So look at question number 8. The following information is provided by DPS Limited for the next year. Raw material period is 55 days, work in progress 18 days, finished goods period 22 days, debt collection 45, creditors period 60, and annual operating cost including depreciation is 21 lakh. 1 year has 360 days. First requirement is to calculate operating cycle. You quickly calculate the operating cycle and number of cycles in a year and tell me how much. Everything is there. Quickly calculate it and tell. I will do the third requirement. Working capital required, I will do it. $55 plus 18 plus this is 30, so that is 85. 85 plus 45 we get 130 minus 60. 70 days, no? 70 days. 55 plus 18 plus 22 plus 45 minus 60. 80 days it is. So working operating cycle is 80 days. So everyone got it? Number of cycles in a year? 4 point. How do you calculate number of cycles? 360 by 80. 4.5 cycles, 1 year. Everyone done till this part? Listen, everyone done with this? Any doubt in the calculation of cycles? Annual operating cost including depreciation is given 21 lakh rupees. So now while calculating working capital using cash cost approach, we have to eliminate the depreciation, right? So question number 8, cash cost for the company is, cash cost is nothing but cost excluding non-cash items like depreciation. 21 lakh minus, for the depreciation 2 lakh 10,000. So how much do we get? 18 lakh 90,000. So this is the annual cash costs. Annual cash cost is 18 lakh 90,000. Clear? Now this annual cash cost of 18 lakh 90,000 is required for how many cycles? Or let me put it in this way. It is required for how many days? Annual cash cycle is required, annual cash cost is for 360 days. Our working capital cycle is only 80 days. So for 360 days, if your cost is 18 lakh 90,000, then for 80 days how much it is? That is your working capital requirement. Working capital requirement is equal to 18 lakh 90,000 into 80 by 360. How much? 4 lakh 20,000 is the working capital required. Clear? Any doubt? You want me to explain it again? So annual cost is 18 lakh 90,000. This is the amount of cash cost required for a period of 1 year. So for 360 days the cost is 18 lakh 90,000. Our working capital cycle is 80 days, which means we don't have access to cash for 80 days. So for 360 days, if it is 1890, then for 80 days, how much it is? 80 by 360 into 18 lakh 90,000. Clear? Any doubt in the 8th question? Everyone done till this part? Now look at question number 9. The following information has been extracted from the books of ABS Limited. Opening stock of raw material and closing stock of raw material is given. Opening stock of WIP and closing stock of WIP is given. Opening stock of finished goods and closing stock of finished goods is given. Average receivables, average payables, purchase is given, wages and overheads is given, selling expense given, sales is given. Look at the requirement of the question. And one more thing, all purchases and sales are on credit basis only. Requirement of the question is, what is the net operating cycle period for the company? Second requirement, amount of working capital required. Assume 360 days in 1 year, right? So here again we have to solve the question using cash cost approach. If it is the cash cost approach question, we have to prepare cash cost sheet. But it is a newly formed company or existing company. Why? Because they have opening stock, right? If it is a newly formed company, opening stock would have been 0. So write down working note number 1, preparation of cash cost sheet. Question 9, working note number 1, cash cost sheet. So cash cost sheet should start with what? Blindly don't write raw material consumed. Here we have opening stock, closing stock and purchases. So opening stock plus purchases minus closing stock. So opening stock of material 1 lakh plus purchases. What is the purchase of raw material? It is 15,70,000 plus 15,70,000 minus closing stock of material 70,000. How much? Raw material consumed is 16, right? Raw material consumed is equal to 16 lakhs. So to raw material consumed we have to add wages plus manufacturing expenses So can someone tell me the numbers? How much wages and how much is the manufacturing expense? Wages, oh, it is given together. Okay, wages and overheads is given together. Wages and overheads 17,50,000. Okay. So raw material consumed plus wages and overheads, what do we get? Gross factory costs. So to gross factory cost, what do we need to adjust? First, what is the gross factory cost? 33,50,000. To this we need to adjust plus opening stock of work in progress minus closing stock of work in progress. Listen, even though it is an existing company, in this case opening stock and closing stock are different. What is the opening stock? 140, closing stock 2 lakh plus 140 minus 2 lakh. So what do we get? After adjusting opening and closing stock of work in progress, we get cost of So what is the cost of production? 3350 plus 140 minus 32,90,000. So to cost of production we need to adjust plus opening stock of finished goods minus closing stock of finished goods. Opening and closing stock of finished goods is given as 230 and 270. So plus 2,30,000 minus 2,70,000. So what do we get after adjusting these two items? We get COGS. How much? 32,50,000. Clear? Any doubt so far? Done. So to COGS, what do we need to add? Selling, admin and distribution expense. Here we have only selling expense 320 plus selling expenses 3,20,000. How much cost of sales? 35,70,000. Everyone done till this part? Any doubt? Clear? So now we have the cash cost sheet. What is the requirement of the question? Listen, we have to calculate the net operating cycle period. So what is the formula for net operating cycle period? Raw material days plus work in progress days plus finished goods days plus receivable days minus payable days, right? Here how can we calculate it? Listen, we have the raw material consumed. We have the average raw material. No, it is not directly given, but we can calculate average raw material. You are all understanding opening plus closing by 2, average raw material. Got it? Then, what is the formula for raw material holding period? Average raw material by raw material consumed into 360. Work in progress, what is the formula? Average work in progress divided by cost of production into 360. Finished goods, average finished goods divided by COGS into 360. So calculate. Working note, don't need as a separate working note, just write it down. Okay, write on working note 2. Calculation of holding period. So calculate raw material holding period. What is the formula? Average raw material by raw material consumption into 360. What is the average raw material? 170 by 2. How much? 85,000 divided by raw material consumption is 16 lakh into 360. How much? 19.125 days. You can round it to 20 days actually. Because it is greater than 19, then it is considered to be the next day, right? So it is better to take it as 20 days. Then we have work in raw material days, then work in progress days, average work in process by COP. What is the average work in process? 3,40,000 by 2, we get 1,70,000. COP how much? 32,50,000 into 360. So 170 by 3250. 18.8 days. Around 19 days. Next, finished goods days. Average finished goods, how much? 230 plus 270 by 2. We get? This is 5 lakh by 2. So 2,50,000. By COGS, how much? 32,50,000. No, COGS. This is 32,90,000, no? Cost of production. You could have told me before itself. So numbers will change, no? 170 by 3290. 18.6, but still okay, 19 days. Okay, so this is 32,50,000 into 360. How much do we get? How much? 28 days. Next, calculate receivable days. Average receivables directly given in the question. 2,10,000 divided by what? You should take credit sales or cost of sales. Listen, you should take credit sales or cost of sales. You should take credit sales. Cost of sales is for calculating working capital requirement. For velocity, it is still credit sales only. Right? Or else let me put it in this way. Let's say you are taking cost of sales here. What is the cost of sales? 32 lakh. Cost of sales how much? 35 lakh 70,000. Listen, if you are taking cost of sales, the problem is numerator is what? Receivables, includes profit. Denominator cost of sales excludes profit. There is an inconsistency. Right? So while calculating receivable days, you should take credit sales only, not what is this? Cost of sales. So it is 42 lakhs into 360. How much? 18 days. Similarly, calculate payable days. Average payable given in the question 3,14,000 divided by credit purchases is 15,70,000 into 360. How much? 72 days, right? So apart from this, do we have any other outstanding? No, nothing. So calculate the first requirement, net operating cycle or working capital period. How much? How many days? How much? 13 days. Everyone done till here? Now listen. What is the annual cost of sales? 35,70,000. So during a period of 360 days, we need 35,70,000 rupees of cash cost. Our operating period is only 13 days. So what will be the working capital requirement? Working capital requirement is equal to how much? 35,70,000 into 13 by 360. How much do we get? 1 lakh? 12 lakh? 1,28,917. Any doubt so far? Clear? Everyone done till this part? Listen, 10th question I will do. Newly formed company. This is slightly similar to the 4th question that we did. So 10th question I will do. 11th question you can take it as your homework. Easy question. So there is nothing much in this. 12 we will do in class. 13, okay, fine. Okay, listen. Question number 10. Day Limited, a newly formed company, has applied to the private bank for the first time for financing its working capital requirement. So first, if it is a newly formed company, what is the first working note that we have to prepare? First working note is credit purchases. Look at fourth question. First working note should be raw material stock. Second, work in progress in stock. Third, cash cost sheet. Clear? And after that, debtors, creditors, everything will come after that. If it is a newly formed company, we have to follow this pattern. If it is an existing company, first working note itself to calculate cash cost sheet. Clear? Any doubt in this? So the following information is available. Listen. Completed units of production is 31,200 units. And work in process is 12,000. Or else can we do one thing? Can I solve 11th one and can you take 10th as homework? Exactly similar to 4th. What do you want me to do? Which one you want to take as homework and which one you want to solve? Tell quickly. I would say 10th one is relatively easy. Exactly similar to 4th one. There finished goods was given as 8,000. Here it is 24,000. Only the numbers are changed. Apart from that, everything is same. Huh? Okay, I'll do the 11th one. You take 10th one as homework. So listen, question number 11. Expected production is 9,000 units per annum. Raw material are expected to remain in store for an average of 2 months before issue to production. So what is the raw material holding period? 2 months or 60 days. Work in progress, 50% complete as to conversion cost. What does it mean? 50% for wages and overheads, 100% for raw material. Work in progress, 50% complete as to conversion cost will approximate to 1 by 2 months production, which is nothing but 0.5 months production. So work in progress holding period is 0.5 by 12. Finished goods remain in the warehouse on an average for 1 month. So finished goods holding period is 1 month. Credit allowed by the supplier is 1 month. 2 months credit is normally allowed to debtors. A minimum cash balance of 67,500 is expected to be maintained. Cash sales are 75% less than credit sales. So what does it mean? First, why they have given this information? To calculate the amount of debtors or receivables, right? How to adjust this, we will see while solving the question. Safety margin 20% to cover unforeseen contingencies. Production pattern is assumed to be even throughout the year. So expected level is 9,000 units per annum, right? So 9,000 units is for 12 months. So 9,000 by 12, 750. Every month we will produce 750 units. The cost structure for Beta Limited is as follows. Raw material cost is given, labor is given, overheads including depreciation is given. So we have to exclude it and solve it. So total cost is 180. Profit 20 and selling price is 200. You are required to estimate the working capital requirement of Beta Limited. First, it is an existing company or a new company. Look at the first line. First line of the question itself, it doesn't say it is a newly formed company. So it is an existing company. So what is the assumption that we have to make? Opening stock of all the inventories is equal to closing stock of all the inventories, right? So start with the cash cost sheet. Question number 11, 11th one, right? Working note number 1. Cash cost sheet. So cash cost sheet should start with what? Raw material consumed. So listen, in this case or in general, raw material is consumed in finished goods as well as in work in process, right? So listen, what is the finished goods? Finished goods, how much? 9,000. What is the raw material cost per unit? 80. So 9,000 into 80, we get the amount of raw material consumed in the finished goods. Plus, raw material is also consumed in work in progress, right? Now listen, this question is different from the above questions that we solved, because in the previous question, that is in fourth question, work in progress in terms of units, it is given. How many units? 4,000 units. When you look at the 10th question also, work in progress in terms of units is given. So work in progress holding period was not available in these questions. But here, work in progress holding period is available. How many months? 0.5 months, right? So, in 1 year's production, 0.5 months is your work in progress. And what is the raw material cost? 280. Is this portion of the calculation clear, or you want me to explain it again? Clear again. 9,000 is the annual production. In 1 year's production, 1/2 months production is work in progress. So 9,000 into 0.5/12, 375 units. So on an annual basis, you have a work in process of 375 units at the end of the year. So 375 is the work in progress units. For 1 unit, the cost is 80. So 375 into 80. Clear? Did everyone understand this part? Listen, let me relate this portion. See, this, it can be, or it can be written as 375 into 80. Now listen, in the previous question, whichever you solved, take fourth question, third working note, cash cost sheet. Cash cost sheet, how did we calculate the raw material consumed? 1,04,000 into 80 plus 4,000 into 80. Similarly, 9,000 finished goods, 375 work in progress. There 1,04,000 finished goods, 4,000 work in progress. Clear? Understood? So what is the total raw material consumed? Clear? Any doubt? Now, to raw material consumed, what do we need to add? Wages. What are the wages? Wages is included in both finished goods and work in progress. So write down wages 9,000 into what is the wage cost per unit? It is 20 plus what is the work in progress in terms of units? Into what is the wage cost? 20. So that's all. We have to multiply it with 50%. Why? Because only 50% of wage cost is incurred till work in progress. Remaining 50% will be incurred after, while converting WIP into finished goods. So how much total wages? 1,80,000. 3. Now to this we have to add overheads. What are the overheads? Overheads again included in finished goods and work in progress. So 9,000 into what plus 375 into what? You tell me the numbers. 9,000 into 60. Why? Because 80 includes 20 rupees depreciation. So into 60 plus 375 into what? Into 30, which is nothing but 60 into 50%. So what are the total overheads? 5 lakh 51 250. So what are the total gross factory costs? How much? 14 lakh 85,000. That's all. Everyone done till this part? Now to gross factory cost we have to adjust what? Plus opening and closing stock of work in progress. But before that, it is an existing company or new company? Existing. So opening and closing stock of work in progress are same. So gross factory cost is equal to cost of production as well. $14,85,000. To this we have to adjust opening and closing stock of finished goods, which is same, so which is equal to cost of goods sold 14,85,000. Any admin expenses given? No. So this is equal to cost of sales also. So cost of sales is also equal to same 14,85,000. Clear? Any doubt? Now, what is the total raw material consumed? Based on this, we can calculate the raw material stock, right? So calculate the raw material stock and tell me how much it is. So raw material stock holding period is how much? 2 months. Stock of raw material, how much? So basically it is 7,50,000 into 2 by 12. Clear? Next, third working note, we have to calculate stock of work in process. Listen, for calculating stock of work in process, listen. Here, this is the amount of work in progress included in raw material. Amount of work in progress included in wages. Amount of work in progress, material cost incurred for work in progress, labor cost incurred for work in progress, overhead incurred for work in progress. So when we add all these three items, we will get the stock of work in progress. Clear? You are all understanding it? So stock of work in progress is equal to how much? Now you tell me the material cost, wages and overheads separately. Material is 45. Material alone how much? 13,000 plus wages 3,375. How much? 3075. Raw material expenses for finished raw material expense for work in progress is 3075. Correct? 1330 30,000 30, that's all. Okay, but how it will be 30,000? It is only 375 into 375 into 80. Okay, 30,000. Next 3750 plus, so totally it is 45,000. Clear? Next we have to calculate working note 4, stock of finished goods. So what is the finished goods holding period? It is 1/12 and cost of goods sold is 14,85,000. So stock of finished goods is equal to 14,85,000 into 1/12. How much do we get? 1,23,750. Clear? Next, working note number 5, debtors or receivables. Now listen, for debtors or receivables, in the question it is mentioned that cash sales are 75% less than credit sales. So assume credit sales is equal to X, right? Then what will be cash sales? Cash sales are how many percent? 75% less than credit sales. So it will be 0.25x. You are all understanding this part. So what is the total sales? 1.25x. Till this part clear? Did you all understand? Now what is the proportion of credit sales and proportion of cash sales? This is 1x, right? So 1 divided by 1.25 is proportion of credit sales. 0.25 by 1.25 is proportion of cash sales. So what is credit sales and cash sales? 80% and 20%. Clear? Any doubt? Now what is the cost of sales we calculated? 14,80,000. Just 14,85,000 is for 100% of sales. But out of this only 80% is credit sales. So debtors should be calculated on credit cash cost of sales. You are all getting the point. So debtors is equal to, see, if nothing is mentioned, what we will do, we will take 14,85,000 and we will multiply it with, what is the debtors holding period? Receivable days is 2 months, right? So if nothing is mentioned, we will take it and we will directly multiply it with 2/12. But here you have to multiply it with what? How much? 80%. Why? Because only 80% is credit sales. Is this part clear or you want me to explain it again? Clear? So what is the amount of debtors? 1,98,000. Everyone done till this part? So 1,98,000 is the debtors. Next, what else we have to calculate? Cash is given in the question, 67,500. Then we have to calculate creditors, right? If it is an existing company or a new company? Existing. If it is an existing company, then credit purchase is equal to what? Raw material consumed. Did you all understand what I told now? What is your doubt? Generally, debtor should be, see, okay, on what value you have to calculate? If you want to calculate it on sales, sales includes profit. So we have to calculate it on cost of sales. That is what we have done in previous question also. I'm not getting your point. This 1,98,000. This 1,98,000 does not include profit. That is what we discussed in this example. Listen. This 1,75,000, this example, listen. The value of the sales is not 1,98,000. Value of sales is something. The actual amount of money that is blocked in the form of receivable is only 1,98,000. Listen. What is the total value of debtors in this example? 1 lakh. From 1 lakh, what we are removing? We are removing 25,000 rupees of profit. So we are left with 75,000, right? This 75,000 is the effective fund that is blocked in the form of receivables. This 75,000 is similar to this 1,98,000. This 1,98,000 does not include profit. You're all getting the point. Understood? Clear? If you want the profit figure, let me try whether information is given in this question or not. I don't know. We did this question. You look at question number 9. Just take the cost of sales that we calculated. 35 lakh 70,000, right? Now listen. That 35 lakh 70,000 does not include profit. What is the sales amount? 42 lakhs, right? That 42 lakhs minus 4,000 minus 8,000. That's a difference of 6 lakh 30,000. No, from 42 lakh and 35 lakh 60,000. That is your profit, right? That 35 lakh 70,000 does not include the amount of profit, right? So similarly, this 1,98,000 also does not include profit. This is the amount or cost of money that is blocked in the form of receivables. This 1,98,000 excludes profit. Clear? Did you all understand? So now we are done with stock of raw material, work in progress, finished goods and debtors. Now next we have to start with what? What is the next current asset? Cash, which is given in the question. So we have to start with current liability as we are done with all the current assets. Working note number 6, creditors. So listen, creditors, it is an existing company or a new company? Existing company. For existing company, credit purchases is equal to what? Raw material consumed itself. What is the raw material consumed? Purchases is equal to raw material consumed. Raw material consumed is how much? 7 lakh 50,000. So purchases is equal to 7 lakh 50,000 into what is the credit period allowed by the company? Allowed by the supplier? 1 month into 1 divided by 12. How much do we get? Clear? Everyone? Any doubt? So we are done with creditors. Do we have any outstanding expenses? No, nothing as such. So now what we can do is, that's all. We are done with all the current asset and current liability. So calculate the total current asset and total current liability and tell me the numbers. minus total current liability. ₹5 lakh. That's all. Okay. Total current liability only 62,500, right? Apart from that, we don't have anything else. Did you add cash to the current asset? 67,500. Apart from creditors, we don't have any other current liabilities here. So total current liability 62,500. $559,250. What is the working capital? Working capital before contingency. $4,96,750. But in this question, there is also a margin of safety margin is given 20%. So plus 20% margin. How much do we get? 20% of this? 99,350. So add it. How much do we get? Net working capital 5. Did you all understand why did we multiply cost of sales with 80%? That everyone clear, right? Because for 20% we don't have debtors. That is cash sales. Only for 80% we have debtors. Clear? Any doubt in this? Everyone done? So look at 12th question. PK Limited, a manufacturing company, provides the following information. So it is nothing is mentioned in the question whether it is a newly formed company or not. So obviously it is an existing company. Sales 108 lakhs, material consumed 27 lakh, wages paid 21 lakh 60,000. Manufacturing overhead including depreciation is 3240. Admin and selling overhead 10 lakh 80,000. Receivables 3 months credit period. Raw material supplier extends 3 months credit period. Lag in payment of labor, so it is an outstanding wages liability. In manufacturing overhead paid 1 month in arrear, again outstanding expenses. Admin and selling overhead paid 1 month in advance. So what is this? Prepaid expense. Inventory holding period of raw material and finished goods are 3 months. So both raw material and finished goods, it is 3 months. No work in progress in this question. PK Limited sells goods at cost plus 33.1/3%. Cash balance is 3 lakh and safety margin is 10%. Requirement of the question is to calculate working capital requirements on cash cost basis. Listen. So here for the since it is an existing company, first working note should be to prepare the cash cost sheet. So write down question number 12. Prepare the cash cost sheet. Ninth question. Yes. Which while calculating days. For calculating receivable days, look at the formula given over here. Credit sales per day. They have not mentioned it as cost of sales per day, right? In ratio analysis chapter also we studied formula for debtors velocity. What is the formula? Receivables by credit sales into 360. Your question is here instead of credit sales, why we are not taking cost of sales, right? If you are taking cost of sales here, The numerator receivable includes profit. Numerator is receivable, that includes profit. Denominator, cost of sales, does not include profit. There is an inconsistency between the numerator and the denominator. So, debtor's velocity is calculated on credit sales only. But while calculating working capital requirement, we should not take the credit sales. From credit sales, we should eliminate the profit and we should calculate debtors based on cost of sales. Clear? Now listen, we are calculating on debtors now. Last question also we calculated 1,98,000. That 1,98,000 will not be shown on the balance sheet. That the amount in the balance sheet will be calculated using this formula. Right? But why we are calculating, why we are removing that profit effect? Because we don't need that, we don't need to borrow our profit. Profit is something which you are already going to get. Then why do you want to borrow that money from the bank? You are all getting the point, right? So understood? So this is, we are calculating this debtors only for the purpose of working capital requirement. That will not be shown in the balance sheet. Break. Okay, we will solve 12th question after the break. We will start at 4:15. We will start 10 minutes. Settle down, we will start. So 12th question, since it is an existing company, the first working note should be to calculate to prepare the cash cost sheet. So write down working note number 1, question number 12. Cash cost sheet. So we have to start it with raw material consumed. Raw material consumed is equal to how much? 27 lakhs. So to raw material consumed we have to add wages and manufacturing expenses. Wages plus manufacturing expenses. So amount of wages paid is equal to 21,60,000. What are the total manufacturing expenses? 32,40,000, but that includes 3,60,000 rupees of depreciation. So we have to remove that. So it is 32,40,000 minus 3,60,000. So how much do we get? $28,80,000. So when we add everything, what is the total? It's nothing but your gross factory costs. How much? 77 lakh 70,000. 77 lakh 40,000. Okay. So to gross factory cost we have to adjust opening and closing stock of work in progress, but here everything is same. So cost of production is also 77 lakh 40,000. COGS is also 77 lakh 40,000. To COGS what do we need to add? Admin and selling expenses 10 lakh 80,000 plus admin expenses how much? 10 lakh 80,000. So how much do we get? 88 lakh 20,000. Clear? Any doubt in this so far? So what is this 88 lakh 20,000? Cost of sales is equal to 88 lakh 20,000. Clear? So now working note 2 should be to calculate stock of raw material, or else in one working note we can calculate stock of raw material, work in process and in this question no work in process. So in one working note we can calculate stock of raw material, finished goods and debtors. So how do we calculate raw material stock? How do we calculate it? Raw material consumed into raw material holding period. What is the raw material holding period? In this case it is 3 months. So raw material consumed is 27 lakh into 3 by 12. How much? 6 lakh 75,000. Next, no work in progress, finished goods stock. How much? Finished goods stock should be calculated on cost of goods sold. What is COGS? 77 lakh 40,000 into finished goods holding period is also 3 by 12. How much do we get? Well, 19 lakh 35,000. Next we have debtors. Debtors should be calculated on cost of sales. Cost of sales is 88 lakh 20,000 into credit period is 3 months, so into 3 by 12. ₹22 lakh 5,000 Next, we have any other current assets to calculate. We have to calculate prepaid expenses here. Admin and selling expenses are paid 1 month in advance. So write down working note number 3. Prepaid expense. So what is the admin expense? Totally it is 10 lakh 80,000. It is paid 1 month in advance, so by 1 into 1 by 12. How much do we get? 90,000. Clear? Any doubt? Everyone understood? Next, any other current assets? We are left with any other prepaid expenses? Cash is given 3 lakh, okay. So that's all, we are done with all the current assets. Let's calculate the current liabilities. First, creditors. So it is an existing company. So raw material purchases is equal to what? Raw material consumed. So raw material purchases is equal to raw material consumed. Did you all understand why it is same? Because opening and closing stock are same. So what is the raw material consumed here? So creditors is equal to 27 lakh rupees of raw material was purchased and the credit period extended by the supplier was 3 by 12 in 3 months. How much? 6 lakh 75,000. Any other current liability? We have outstanding expenses. Labor is also paid in arrear. Manufacturing overhead is also paid in arrear. Both the expenses are paid 1 month in arrear. So what we can do? We can club both the expenses and multiply it with 1 by 12. So working note 5. Outstanding expenses. Wage expense 21 lakh 60 plus manufacturing overhead. How much? Manufacturing overhead. How much? What is the total? How much? 54 lakh. So listen, 2160 plus 3240 minus 360 because there is a depreciation of 3,60,000. So outstanding expense is equal to 50 lakh 40,000 into, it is paid in arrear of 1 month into 1 by 12. How much do we get? 4,20,000. Is this clear to everyone? Did you all understand? Next, any other current liabilities? No, that's all. So calculate the total asset and total liability. Total current asset and total current liability. Total current asset. Then what is the total current liability? Cash is 3 lakh. Yes, total current asset, how much? 40? 52 lakh 5,000. Total current liability is 4 lakh 20,000 plus 6 lakh 75,000. So it is 10 lakh 95,000. Net working capital before contingency. How much? Plus there is a margin of, safety margin is 10%. Plus 10% margin. We get 4 lakh 11,000. So we will get 45 lakh 21,000. This is the net working capital for the company. Clear? Any doubt? Admin expenses? This 10 lakh 80. Okay, correct. So what is your doubt on that? Means I'm not getting your point. You're asking why we are adding 10 lakh 80,000. So? Oh, you're asking why we are not removing prepaid expenses from this. Okay, listen. In the month of you're in the month of December. Let's say December 31st is the balance sheet date. Next month is January 1. What are the prepaid expenses? So you are paying 90,000 rupees in the month of December. For this you are going to get the benefit in January. Similarly, you would have paid some expense in November, for which you will get benefit in December. Last year December you would have paid 90,000. For that you will receive benefit in this year January, right? So totally on an annual basis 10 lakh 80,000 is the admin and selling expenses. Why we are taking 90,000 as the prepaid expense? Because we have paid this in December, but we are going to receive this benefit in next year Jan. So as on 31st March this is an asset for the company. So we are including that 90,000. Is it clear? So totally during a period of 12 months, 10 lakh 80,000 is the total selling and administration overhead for the company. So every month the company is paying the expense in advance. So on an overall basis, 10 lakh 80,000 is the expense for the company. Or else let me put it in this way. Out of this 10 lakh 80,000, 90,000 into 11, how much? Into 11, 9 lakh 90,000, right? So during the year, this company paid 9 lakh 90,000 rupees, and for that 9 lakh 90,000 rupees, in this year itself the company enjoyed the benefit. Got it? Remaining how much is there? Difference, 90,000. This 90,000 was paid in the previous year, for which the company is receiving benefit in this year. So what is the total amount for which the company is enjoying the benefit? 10 lakh 80,000. Got it? Clear? Any doubt? But during this year the company paid 90,000. But that 90,000 the company did not enjoy the benefit. That will be realized in the next year. Clear? Any doubt? Understood? Opening and closing prepaid in the sense? No, it is getting expired within a period of 1 month. No. If it is opening, December expense is expired in January. January expense is expired in February. December expense is not expired at the year end. December expense will be expired in Jan. At the year end, on 31st March, it is not expired. So we are showing it as the current asset, prepaid expense 90,000. Got it? So that is what I am saying. Out of 90,000 paid, 11 times the company enjoyed the benefit or they got this service. But for the 190,000 they paid, they did not receive the service. So that is shown as a current asset. Clear? Any doubt? Understood? Question number 13, listen. Question number 13 is not a study material question. It is not a PYQ as well. Right? It is similar to question number 6. It is included just for your practice. Whenever you have time, you can just try it. I will give the solution. I will give you a proper PDF solution for that. But question number 13 is slightly relevant to question number 14. Question number 14 will take some time. We will do this tomorrow. Right? So what is important to understand is there is a concept in question number 6 which will be discussed in question number 14. Right? So we will do question number 14 tomorrow. We will finish 15 and 16 today and we can call it a day. Small questions. 15 is very small, 16 is also very small. Look at question number 15. Because with this, the chapter is almost done, that's all. Only 16 questions are there. Tomorrow we will solve double shift and question number 14. So look at question number 15. The following annual figures relate to M&P Limited. Sales given, material consumed given, wages given, manufacturing expenses, total admin expense, sales promotion expense. When you compare question number 15 with question number 12, exactly same. Right? But there is a small hidden adjustment in this question. Look at manufacturing expenses. Manufacturing expenses outstanding at the end of the year is 2 lakh and cash expenses paid 1 month in arrear. What they are saying here, just look at this part. This is the only new adjustment in this question. Apart from that, everything is same. What is this manufacturing expenses outstanding at the end of the year? Or else we will do one thing. First, see, in all the working capital question, first you have to check whether it is a newly formed company or existing company. Newly formed company, first working notice, stock of raw material. Second working note, work in progress. Third working note, cash cost sheet. Existing company, first working note, cash cost sheet. Existing company, 15th question. So we have to prepare the cash cost sheet first. So I will prepare, along with that I will explain the adjustment. Listen. Question number 15, cash cost sheet, working note 1, cash cost sheet. So first we have to start with what? Raw material consumed. Raw material consumed how much? 22 lakh 50,000. Then we have to take wages paid. Wages paid is equal to 18 lakh. Then what else? What is the next thing that you have to write? After wages paid, we have to write what are the manufacturing expenses? What is the amount given in the question? It is not 2 lakh. It is manufacturing expenses outstanding at the end of the year. So this is nothing but outstanding expense. It is a current liability. You are all getting the point. Understood? They have not given the manufacturing expenses. They have given the current liability. we have to calculate the manufacturing expense. How to calculate it? Listen, cash expenses paid 1 month in arrear, which means January expense will be paid in February. February expense will be paid in March. March expense will be paid in April. April. So April expense will be paid in May. So there is a 1 month lag in the payment of manufacturing expenses. So this 2 lakh is for how many months? 1 month. Then what is the total annual manufacturing expenses? 2 lakh into 12, 24 lakh. So manufacturing expenses (2 lakh into 12), we get 24 lakh rupees. Clear? Did you all understand? If it is a new company, we have to take into 2 lakh into 12 only. We are not considering the cash paid. We are considering the manufacturing expenses. Even though it is a new company, to the P&L account, see what is accrual concept of accounting basically. What is accrual concept of accounting? When cash is coming in or cash is going out, doesn't matter. If you have incurred the expense, you have to record it. Here, even though it is a new company, during a period of 12 months, they have incurred an expense of 2 lakh each. For 1 month, it is 2 lakh each. So they will recognize an expense of 24 lakh to their P&L. 2 lakh is not paid, right? But still, that expense will be recognized. Did you understand? Got it? So what are the gross factory costs? ₹64 lakh 50,000. Two gross factory costs we have to add. Opening and closing stock, but here it is same. So COP is also equal to 64 lakh 50, and COGS is also equal to 64 lakh 50,000. Then admin expenses, admin is also given 6 lakh. Sales promotion is also given 12 lakh. So add both admin and sales expenses. Admin expense and then sales expense. Admin expenses 6 lakh, sales is 12 lakh. How much total cost of sales? 82 lakh 50,000. Understood, everyone? So now working note 2 should be to calculate what? We can calculate stock of raw material. Any work in progress? Wait, we did not read this from here to here itself. Listen, the company sells its product on at a gross profit of 25%. Irrelevant, ignore it. It is not relevant at all here. Assuming depreciation as a part of cost of production. Listen, what is the cost of production we calculated? 64 lakh 50,000. Does this cost of production include depreciation or excludes it? Look at the question and tell. How includes? See, material consumed does not include depreciation. First, cost of production includes what? Material consumed, wages paid plus manufacturing expenses. Got it? Material consumed does not have depreciation. Wages paid does not have depreciation. Manufacturing expenses also cash expenses specifically mentioned in the question. So they have given depreciation just to confuse you. Ignore it. Right? Clear? Any doubt? So depreciation as a part of cost of production. This cost of production is nothing but cash cost of production. This COGS is nothing but cash cost of goods sold. This is cash cost of sales. All the expenses included in this cost sheet are cash cost expense only. Clear? No non-cash items are included in this. It keeps 2 months of finished goods in stock and 1 month of raw material as inventory. Cash balances 2,50,000. Assume 5% safety margin. Requirement is to prepare working capital estimate and ignore work in progress. Stock of finished goods to be valued at manufacturing cost, which is nothing but cost of goods sold, whatever we calculated here, 64,50,000. So write down stock of raw material, no work in process. So finished goods and debtors. So calculate raw material stock, finished goods stock and debtors. Tell me the amount. Raw material stock will be calculated on what? Raw material consumed. Raw material consumed is 22,50,000. Raw material holding period is how much? 1 month into 1 by 12. How much do we get? 1,87,500. Next we have finished goods. Finished goods should be calculated on COGS. What is COGS? 64,50,000. Finished goods holding period is 2 months into 2 by 12. How much? 10,75,000. Next, debtor should be calculated on cost of sales. How much? 82,50,000 into what is the credit period allowed by the company? 3 months into 3 by 12. How much? We get 20,62,500. So apart from this, we have the next current asset is cash directly given 2,50,000. Any other current assets? Look at the question. We have prepaid expenses. Sales promotion expenses paid quarterly in advance. So calculate working note number 3, prepaid expenses. Prepaid sales expense. ₹12,00,000 into, it is paid quarterly in advance, so 1 year has 4 quarters and 1 quarter has 3 months. So we should multiply it with 3 by 12 or we can directly divide it by 4. How much do we get? Any doubt in this? Clear? Understood? Prepaid sales expense done. Any other current assets we have? Cash, fine, that we can write directly. So we are done with all the current assets. We can start with working note 4, creditors. 2,50,000. So now listen, creditors, existing company, so purchases is equal to what? Purchase is equal to consumption. So what is the raw material purchased? Sorry, consumption. 22,50,000 into creditors allowed a credit period of the extent 1.5 months. So into 1.5 by 12, how much do we get? 20. $2,81,250. Next, what is the next current liability we have? One current liability is directly given, that is manufacturing expenses outstanding. How much? 2,00,000 rupees. Current liability is directly given. Then we have outstanding wages and outstanding admin expenses. So working note 5, outstanding expenses. So both wages and admin, they are outstanding for 1 month. So we can club together and solve it. Outstanding wages and admin is equal to how much? Totally it is 18 lakh plus 16 lakh. We get 24 lakh into they are outstanding for 1 month. So how much do we get? We get 2 lakh rupees. Clear? Any doubt? Next, outstanding manufacturing expense. That is also same, 2 lakh. So total outstanding is equal to, total outstanding expense is equal to 4 lakh rupees. Clear? Any doubt? So that's all, right? Any other current liability? No, that's all. So tell me the total current asset and total current liability. See, in your exam you have to prepare the statement properly. Due to time constraints we are doing it like this. So while practicing, prepare the statement properly and do it. I did it for 2 questions in the concept analyzer. So total current asset and total current liability. How much? Total current asset? 8 lakh 75. 38 lakh 75,000. Total current liability? 4 lakh plus 6 lakh 81 250. 6,81,250. So working capital before contingency is how much? Net working capital before contingency, how much? 38,75,000 minus 681,250. 31,93,750. To this we have to add 5% margin. How much? 159,687.5. So what is the net working capital? How much? 33. Everyone done? Oh, 38. Okay. Clear? Any doubt? So last question, question number 16. Cost sheet of A&R Limited provides the following particulars. Again, an existing company. So raw material cost, labor cost, overhead costs are given, total cost, profit and selling price is given. The company keeps raw material in stock on an average for 4 weeks, work in progress on an average for 1 week. Finished goods in stock is an average for 2 weeks. Credit allowed by supplier is 3 weeks and company allows 4-week credit to their customers. The lag in payment of wages is 1 week and lag in payment of overhead expenses 2 weeks. So here we cannot club the expenses because the outstanding, the lag in payment is different. The company sells 1/5 of the output against cash and maintains cash in hand and bank put together 2,50,000. What is this? 1/5 of output against cash. What does it mean? What is 1/5? 20% is cash sales, 80% is credit sales. 1/5 is what? 20%. So they are selling 20% on cash basis, remaining 80% on credit basis. Clear? Requirement of the question is prepare a statement showing estimate of working capital needed to finance an activity level of 2,60,000 units of production. Assume production is carried out evenly throughout the year and wages and overheads accrue similarly. Work in process is 80% complete in all aspects. What does it mean? What does it mean? It means that work in process is complete 80% with respect to material, wages and overheads. Material is also not 100% here. You are all getting the point. It is specifically mentioned in the question 80% complete in all respects. So for material also we should take 80% only. Clear? Any doubt? So write down question number 16. So here in this question we can directly calculate the stock of raw material and stock of work in progress without calculating the cash cost sheet. So listen, working note number 1, because they have not mentioned specifically the work in progress in units, no. So what we can do is stock of raw material. So generally how do we calculate raw material? The company is expecting to produce 2,60,000 units, right? So 2,60,000 units into 200, and raw material is, we are holding the raw material in stock for how many weeks? 4 weeks. So 2,60,000 into 20 into 4 by 52. Into 4 by 52. How much do we get? Stock of raw material, clear? Any doubt? Did everyone understand this part? Next, working note number 2, stock of work in progress. So work in progress includes raw material 80%, wages 80%, overheads 80%. So work in progress should be valued at, so write down raw material the company has produced 2,60,000 units of production, out of which 1 by 52 is work in process. Is this clear? In the question here it is mentioned work in progress on an average for 1 week. So out of total production, 1 week production is work in progress. They have not given the work in progress in terms of units directly. So 2,60,000 into 1 by 52 we get 5,000 units. So this 5,000 units is nothing but work in progress units. Similar to fourth question where work in progress was directly given in terms of units, 4,000. So here we are calculating 5,000 units. Into what is the material cost? 200. Can we take this 200 100%? No, we have to take only 80% of it. Similarly, wages, we have 2,60,000 units, out of which 1 week production is work in process, into what is the labor cost? 75. Into 75, on which we have to take how many percentage? 80%. Similarly, overheads 2,60,000 into 1 by 52 is work in process, into overhead cost is 150. Nothing is mentioned in this question about depreciation. So we can assume the total overhead cost is cash cost only. So into 150 multiplied by 80%. So when we add everything, all these, what is the total work in process? $8 lakh? No, you tell me the total. $17 lakh. Clear?